All right, welcome everyone again. Welcome to the annual UCLA Anderson Forecast, Orange County Economic Outlook. This is in collaboration with the UCI Paul Merage School of Business here at UC Irvine and the UCL Ziman Center for Real Estate at UCLA Anderson. So for those of you who do not know me, my name is Clement Bohr. I'm a senior economist at the UCLA Anderson Forecast and professor of economics at the Anderson School of Management there. And your first speaker today. We have a great agenda for you guys coming up. We're first going to walk you guys through the forecast for the U.S., the California, and then Orange County. And we're going to end off with a commercial real estate survey update from Alan Matkins. And then we're going to take a quick break. And after that, we have two panels coming up, one that's hosted by the UCL Paul Merage School of Business here on real estate, and then one on real estate from the Ziman Center at UCLA Anderson. So before we really get started, though, I need to thank all our sponsors at the UCLA Anderson Forecast. So we have at the principal level, RSM and Yamaza Resort Casino at Samuel. We have at the platinum level, law firm of Alan Matkins, Cathay Bank, Federal Home Loan Bank of San Francisco, Mercury Insurance, and University Credit Union. Then at the gold level, we have Bank of California, Hub International, Leap Development, Robert Half, SMBC Manu Bank. At the silver level, we have McCarthy Cook & Company. At the bronze level, we have Gensler and MBK Real Estate. And lastly, at the Bruin level, we have Cushman Wakefield and IMA. So thanks again to our sponsors. You know, we're a public institution at a university, and we really could not put these programs on without their generous support. So with that being said, let's get right into the program and start with how the U.S. economy is doing. There we go. So I titled this initial talk for the U.S. economy a series of unfortunate supply shocks, because if anything during the 2020s, what we've experienced is first supply chain disruptions because of the pandemic. Then we had the Russia invasion of Ukraine and the energy and food shock that was associated with. And then later on, we had tariffs, we have immigration, and now we have the next energy supply shock hitting the U.S. economy, which is the rise in the price of oil due to the war in Iran. And so that's what I'm showing you here for the West Texas Intermediate crude oil prices, the percent change in that price since the beginning of the year, as well as many derivatives of this. You know, so we have heating oil, jet fuel, diesel, and then regular gas. And what you see is that between these different derivative products, they've risen from anywhere since the beginning of the year of about 50 percentage points to already above 100 percentage points at their peak impact. Right? And so you may have heard that this is the largest supply shock in the oil in history. We produce and consume about 100 million barrels per oil a day in the world, and the Strait of Hormuz ships out about 20 million barrels per oil, so that's 20%, right? Now we've made up about half of that through other means, such as the strategic reserves we have released. We have the pipeline across Saudi Arabia was also able to boost production and you know, get some of the oil out of the Strait over to the Red Sea instead, and that's also upped it by about 5 million barrels per day, which means that at the end of the day, the shock is really closer to 10% or 10 million barrels per day in its magnitude. And so the International Energy Association characterized that as the largest shock, both in absolute magnitude as well as in percent, in history to the oil industry and the global economy in this regard. Now, I think that's a bit unfair because though on a daily basis that is the largest shock in history, what's very different from this shock is that it's likely going to be quite temporary, right? So we have this very large shock on impact, but everybody expects that eventually we're going to get back by the end of the year, most likely, to a place where, you know, the Strait of Hormuz is fully open again and oil is shipping through it. Whereas supply shocks in the history haven't been these very temporary scenarios before. And so what I've plotted for you here for the crude oil forecasts is different scenarios. You know, we have a very unfortunate scenario, which is one where the war breaks out again and in a sense of escalation, and the price of oil begins to rise because of that, and we don't begin to see some sort of truce again coming through the fall. Then we also have this prolonged summer stalemate where there isn't a re-escalation of bombing, but you know, the Strait of Hormuz stays closed as it is right now. And if that happens, you know, oil prices will continue to rise before eventually coming down later in the summer if a peace does come out later then. Now, what we have in our baseline forecast, and I'll talk more about later when it comes to inflation, is this choppy de-escalation phase, right? So I'm not going to tell you that I can prognosticate future geopolitical events, but but we have in our forecast right now that it really seems like neither of these sides really want to escalate this conflict further. But at the same time, they don't see eye for eye at all, and there's no space in between them. So we don't have a rapid de-escalation where the Strait of Hormuz opens tomorrow, but we do expect it eventually to open, over the next coming months. And so now we have two big energy supply shocks that happened in the 2020s. And you may have heard this parallel that this sounds a lot like the 1970s, where you had a big oil supply shock around 1974 because of the OPEC oil embargo that happened then, and then again in 1979 because of the Iranian Revolution that happened then. And so what I want to do is make a comparison to see if that is actually a fair comparison to make today. So what I'm showing you here in yellow is the headline inflation rate back in the 1970s, where you see it started out around 5% in the beginning and rose up to about 15% at the second peak. And that was really driven by these oil supply shocks, which are the price changes in the very skinny yellow line down at the bottom. That y-axis that's associated with the skinny yellow line is on the right side of the figure. So that's why it looks so small, but those small spikes are actually more than 100% increase in the price of oil during those times. So those are very large increases in the price of oil, and that's why they created these large spikes in inflation at the same time. So let's compare that to the 2020s, right? We had the supply chain disruptions and the war in Ukraine, which led to this initial supply chain energy shock, where you see that we're not at the levels we were in the 1970s. First of all, we started off at a baseline inflation rate that was lower, and then also at a peak inflation rate in 2022, reached around 8%, not as high as what the first energy shock was in the 1970s. And we are just at the beginning of the second energy shock, which is why we don't have data on it yet. But we do certainly expect there to be a very notable one, but nowhere near the level of what we had in the 1970s. And you can already see a big part of that is because just that baseline difference, right? The yellow line starts off at a much higher rate than where the thick blue line is today. And the reason for that is that inflation expectations were much higher back then, and the central bank had a lot weaker credibility in controlling inflation than it did today. And so in the dashed line, I'm showing you inflation expectations in the 1970s and in the 2020s in blue. And what you see there is that during the two big inflation spikes in the 1970s, inflation expectations also rose and throughout that entire decade and was really pulled up by these price spikes. But during the COVID-19 pandemic, inflation expectations barely rose at all. Inflation expectations were very well anchored because we have a highly credible central bank in this country that there is expectation that they will bring it back to 2%, which is the inflation target. And so that's also very promising in the sense that if the Federal Reserve can maintain their credibility to bring inflation down, we also should not see a larger escalation in inflation going forward through this second inflationary price shock. But the risk is certainly there because it has been more than 5 years now since we have been at the inflation target. So that being said, the first topic of the US economy I want to talk about is the real estate market, because this is a real estate conference. And another impact of the war in Ukraine is that if you look at this gray line, which is the 30-year fixed rate market mortgage rates right now, it had this spike of almost 50 basis points that happened over the last month, right? And that's the last thing the residential real estate market needed right now, because what I'm also showing you in this figure is the share of outstanding mortgages, of already pre-existing mortgages, where a darker color indicates there's more people who own a mortgage with that interest rate in the area. And so you can see that the gray line, which is the market rate for a new mortgage, is up around 6.5%, but the majority of people have a mortgage from their early pandemic era that are between 3 and 4%. And when the current market rate for mortgages is that much higher than the mortgage people have, they just have no interest in moving. They're not going to sell and upgrade to a much more costly mortgage, and that also means they're not going to buy. So this leads to just a frozen real estate market where there's very little demand and a very little supply for existing housing. Another issue with that is that the pandemic also induced a huge surge in the value of homes, and so it also just makes new home or purchasing a home now that much more affordable relative to people's incomes at these higher interest rates. And because of that, we have growing signs of distress in the housing market. We have growing inventories of new construction, new housing built that can't be sold because there just isn't much demand for new housing out there across the US economy. And because of that, we also have multifamily delinquency rates that are going higher. Now, it sounds scary to say higher than the Great Recession peak. Overall, the multifamily delinquency rates are always very low. It's a very stable market, but it's still a sign of concern when you see that the levels are at rates similar to the Great Recession. Yeah. So the other market that is also very stagnant at the moment is the labor market, and is characterized not as a no buyer, no seller, which I told you guys about, but as a low fire, low hire labor market. There just aren't a lot of people being hired and aren't a lot of people being let off. It's just fairly frozen. And that's what I'm showing you here in terms of employment growth numbers over the last couple of years. You see, if you go back to 2023, 2024, the average monthly job gains was about 100 to 200,000 people per month. And if we had gone back then and extrapolated forward, we would have expected it to remain around 100 to 150,000 employment growth per month. But that's not what happened. We saw this gradual decline almost to zero, right? And you can clearly see in the different colors what led to that continual decline in the average monthly employment growth rates throughout 2025 is that purple bar, and the gray bars, which is employment contracting in industries that are mainly blue collar, such as manufacturing, transportation, and warehousing, and in government due to the DOGE Department of Government Efficiency layoffs. So that really reduced employment growth throughout 2025 almost to zero. Oddly enough, however, this didn't lead to a large deterioration in the labor market, because at the same time, we also had the labor supply, or the U.S. labor force, decline in its growth rate to a low similar level, just around 50,000 a year. And this is very also easily to attribute once you split up what actually led to this decline in the labor force growth. And you see these yellow bars relative to the blue bars, where the blue bars is the employment growth due to the native-born population, and where the yellow bars are due to the foreign-born population, right? So the decline in the yellow bars there is attributed to the recent immigration and deportation policies, which has really led to a reduction in the total labor force in the U.S. economy. We still currently have Jerome Powell as our Federal Reserve Chair. He's likely going to step down and be taken over by Kevin Warsh next month. But would he characterize this labor market back in September as a curious kind of balance? Because even though everything is looking kind of bleak, the unemployment rate is fairly stable. It crept up a little bit, but it's fairly stable. I think that's an unfair characterization as calling it curious when you have both a negative labor supply shock as well as a negative labor demand shock. That's not curious. That's just even worse than if you just had one or the other. And it's also not a balance in the sense that we did see a gradual rise in unemployment rate. It wasn't extreme. We're still very close to full unemployment, but it certainly wasn't the fact that the unemployment rate was just stable last year. That being said, that was a lot of negative information, but all told, the U.S. economy is actually doing very well, and GDP growth held up very well last year, and that's what I'm showing you in the left plot here. Instead of looking at headline GDP growth, what I'm showing you is core GDP growth in the black line. And the reason why I'm doing that is because headline GDP growth can be very volatile, especially last year because of large fluctuations in imports, exports, and changes in inventories. That was largely due to the tariff policy, right? But in general, these parts of GDP are more volatile. And so to get a real good sense of what's going on with GDP growth, we like to strip those out and just look at core GDP growth. And the core GDP growth components are made up of these three different colors. The blue is consumption expenditures growth, the yellow is investment growth, and the gray is growth in government expenditures, both federal, state, and local. And so what you see is that, yeah, the growth rate last year through 2025 was slightly lower than in 2023 and 2024, but it was still at 2%. That's a great growth rate for the U.S. economy. That's slightly above the long-run average growth rate that you have going back to about the 1940s. But if you squint at this figure, you can also see that 2025 looked quite different from 2023 and 2024. So first of all, if you look at the blue bars, the light blue bars are almost absent, and the dark blue bars are noticeably smaller, right? That's reduced consumption expenditures primarily because of tariffs. If you look at the gray bars, you have this big negative gray bar in the fourth quarter of 2025. That was the government shutdown. And then if you look at the yellow bars, there are now, relative to the previous years, these large yellow fat bars, which is investment in high-tech investments, such as AI-related investment mostly, right? And so you see here that there was a large shift last year from consumption growth driving the economy towards AI investment really boosting and driving a lot of GDP growth in the economy. And so a crucial question going forward is, well, can this AI investment continue to drive growth in 2026 and beyond? Right? Now, for 2026, the answer is clearly yes. All the large hyperscaler firms, which are the big tech firms that are building out the AI infrastructure, have already increased their investment expenditures and their projections for investment in 2026. They almost doubled them from around 400 billion a year to 660 billion a year. That's 2% of GDP. So for 2026, we're certainly going to see a continued level of large, fat yellow bars there driving GDP growth. But beyond 2026, it's a real question of how much they continue to increase their investment levels. If they're already at 2% of GDP, that's a very large number of investment expenditures in this one industry. At the same time, they are burning through their entire balance sheet. In terms of their cash flows, AI investment expenditures of the big tech firms is now 90%. So they really don't have a lot more space to build out unless they want to take on a lot of debt. And a lot of the tech firms are actually taking a lot of debt out. And not all of them are still in positive cash flow, such as Oracle is deep in negative cash flow. So for 2026, this is going to continue to boost the economy. But going beyond that is a real question of how much longer these firms can sustain this level of investment growth. And what I just mentioned to you guys should sound puzzling in the following sense. I just told you that the labor market was completely stagnant, but GDP growth was pretty good, right? And so there's this big question out there about, well, how can we have all this jobless growth? Like, that seems very strange. How can the economy be growing, but we're not really adding any new jobs? And from an accounting perspective, it's very simple. If you're producing more with the same amount of people, each person is producing more. Right? So, and that's what productivity growth is. So, and what I'm showing you in this figure is actually that what we have right now, there's nothing historically unusual about it. So this is a scatter plot of employment growth on the x-axis and of GDP growth on the y-axis, where each dot is a different quarter going all the way back to 1947. And then you have the black, which is the trend line through it. And then I've highlighted the 4 quarters of 2025. Right? And what you see is that we are right around the trend line in the cloud of scatter plots going back to that time. So that means that, you know, we do have decent productivity growth. It's not that productivity growth is low. It's around 2%, and that's fantastic. But we also have slightly lower growth overall because employment growth is slightly lower, right? And so I think one reason why we've had a narrative that we're in very high productivity growth is that people have sort of cherry-picked 25, Q2 and Q3, which showed very strong productivity growth. But as I just mentioned to you, GDP numbers are very volatile. And so if you include the first quarter and the fourth quarter of 2025, it would look the exact opposite, right? And so if you want to get a good sense of the signal from the noise, you have the average over the entire year. And what you see is that we're right around the trend line, perhaps slightly above the trend line, which would indicate that historically we're consistent with productivity growth historically, if anything, slightly above it. Now, how has the Federal Reserve reacted to all of these changing dynamics in the economy? Well, in the end of 2025, they decided to lower interest rates by 75 basis points, right? The main reason why they did this was the deteriorating labor market. As I mentioned, the labor market actually held up fairly well, but there was this gradual increase in unemployment rate that was very concerning for them, and so they decided to hedge their bets, especially under all the political pressure and the missing and flawed data they were facing due to the government shutdown, to lower interest rates to just make sure that the bottom didn't fall out of the economy. And the question is, well, was that a reasonable thing to do? Was that the appropriate thing to do? And first of all, it means that what I'm showing you here in green and red is what impact this interest rate will have on the economy, whether it's going to be boosting the economy or whether it's going to be inhibiting and restricting economic growth. Whereas the white area is the area where it's going to be neutral. It's not going to have either effect. And in the green area, it's where it's actually going to end up boosting the economy. So if anything, now they've lowered interest rates to actually be supporting the economy. And that was one of the goals of this change in interest rates because they were worried about the labor market, right? But the Federal Reserve also has another mandate, which is inflation, right? And so if you look at inflation, strong GDP growth, and very frothy financial markets, and you take that into account, well, then the question is, was it really appropriate to lower interest rates so much, right? And so what I'm showing you here in blue and yellow instead is a measure of what appropriate interest rate policy would be when you take into account both the labor market side of things as well as the inflation side of things. Whereas a blue policy is essentially one that doesn't care about inflation and focuses solely on the labor market. And there you see that they're even deeper into the blue area. So they're really not, according to the interest rate policy, focused particularly on the inflation issue right now, which, before the Iran war, what you could make an argument was perhaps okay if the tariffs were a one-time pass-through and inflation would have come down. But now we also have another spike in inflation that will be coming because of the Iran war, and so there is a question as to how fast they can lower interest rates going forward, or even if they might have to raise interest rates to sort of get back on track and not stimulate the economy at a time when you actually have a lot of underlying inflationary pressures. The last thing I need to mention is that we also have a lot of fiscal stimulus coming in 2026. That's mainly in the back of the tax bill that was signed last year in the summer, which went into effect this year. So we have both the tax cuts, but also the refunds from the tax cuts because they retroactively went into effect, counting for 2025. That's what you see in the green bars in this graph. Then in the orange and red bars, you have the new spending coming from increased expenditures on defense and Department of Homeland Security, the military and the like. And then you have, in blue, you have the spending cuts. And what you see is that in the blue, you have the spending cuts. They don't really begin to hit the economy towards the end of 2026, start of 2027. That's the cuts on Medicaid, on SNAP, the removal of the green investment subsidies and the likes. And so what this means is that for 2026, the fiscal stimulus is positive, around 0.5%, but then going into 2027, it's actually going to be negative and going to be restricting the economy going forward after that. So what does this all mean for our outlook for the US economy? Well, first of all, we expect the unemployment rate to just rise ever so modestly from where it is right now. This is not a huge increase in unemployment rate. We're around 4.3, 4.4 right now, and we have it going to 4.5, 4.6. This is mainly on behalf of the shock to energy due to the Iran war, which is going to bump it up a slight bit. But other than that, we have a very stable unemployment rate because of all the fiscal and monetary and AI stimulus coming in. When it comes to interest rates, we do have the headline inflation rates rising to 4% by the end of the year. There isn't really much you can counter with this or argue about this. A lot of it is just a direct effect on inflation. If 3% of the consumption budget is consumption on fuel and gas rose by 50% in prices, well, that's a direct increase in the inflation rate of 1.5%. Okay? But what you see here in the dashed line is the core inflation, and you see that there isn't much of a rise in that towards later in the year, right? And the core inflation strips out these volatile components of food and energy instead, and in an attempt to measure just what the underlying inflation rate of the economy is. And there you only see a slight uptick in inflation. That's primarily because there is an uptick because of the spillovers that come from the energy price shock. So, right, the energy price shock raises the fuel prices. That's going to make transportation and shipping of goods more expensive, which means all your retail goods are going to be more expensive. All your agricultural and food supplies, right? The farms are basically run on diesel. It's a huge energy consumer, and so food prices are also going to go up. There's also been a blockade of fertilizers going through the Strait of Hormuz, so there's also going to be a direct effect there on food prices from that. Restaurants are going to have to raise their prices because dairy ingredients are going to go up. You could go on and on. Some people are going to want higher wage rates because they want larger cost of living adjustments. And so all of these underlying spillover effects are going to slowly build into the economy over the year, with the headline inflation, with the core inflation rate, rising above 3 to 3.5% by the beginning of 2027, and then after that coming down again. What does that mean for interest rate policy? Well, here I have shown you the yield curve. The yield curve is showing you the interest rates for different government credits. So you have the federal funds rate, which is the overnight loan market on the left, and then over on the right you have the 30-year treasury rate. So that's long-term government debt. And what you see with blue being historical yields and the yellow ones being future yields is that from the light yellow to light blue, from the light blue to the light yellow, you basically have very little change in these over this year. So very little change in interest rates through 2026. That means that the Federal Reserve is likely not going to lower or raise the interest rates throughout this year. They're just going to sit pat. There was just, they actually met today and they decided to hold the federal funds rate fixed where it is. They're trying to see through this inflationary shock and then hopefully they can start lowering it again in the future in 2027 and 2028 once we've gotten through this next inflationary shock. And so that's why you see in the dark yellow line that eventually that federal funds rate on the left is going to come down to 3 to 3.25%. And then lastly, to end off, we do still expect very robust GDP growth. We have a lot of stimulus in the economy. We have the AI investment, we have the fiscal stimulus, we have the monetary conditions being much more accommodative now. And so before the oil shock, we had this, in the high twos. Now because of the oil shock, we've lowered this to be in the low twos instead, but still very strong GDP growth going forward over the next couple of years. As always, there are a lot of risks to the forecasts. The main one right now being an escalation of the Iran war. I mean, if we begin bombing again and the Hormuz Strait is closed throughout the entire year, that's going to completely change the outlook for the U.S. economy, right? So there's a lot of risk underlying the current economic projections, as well as a bunch of other concerns, but I don't have time to cover them right now. So thank you. So next up, we have William Yu, our economist at the UCLA Anderson Forecast, and he'll cover the California economy.
Hello, everyone. Good afternoon. I'm glad to be here to talk about California economic outlook. So let me begin to answer this general question. How is California economy doing, right? You might wonder. So here in this chart, let me show you these two most important macroeconomic variables. The blue line is real GDP year-over-year growth rate, and the red line is non-farm payroll job year-over-year growth rate. On the left is United States, on the right is California. So basically, you can see in general, real GDP growth rate is higher than payroll job growth rate. And as Clement was talking about, usually we say this gap, we can say is a productivity growth. So let's look at the number. So let's focus on left. For the United States, from 2013 to 2019, the GDP growth rate average is 2.5%. The job growth rate is 1.7% a year. And so you can say the productivity growth probably is like 0.8%. And then if we look at the recent 2 years, because COVID period, and then there's a lot of up and down. So let's just focus on 2024 and 2025. The US GDP growth rate is 2.5%, almost the same as a pre-COVID period. Job growth rate declined to 0.8%. So the productivity growth, you can say, is 1.6%. And I think Clement explained a lot about what's going on here. So let's look at California here. So between 2013 and 2019, that is, I'm not sure if you guys still remember, that's a good old time, tech boom. At that time, California create 5 out of big tech, 7 big techs, corporation called Magnificent Seven. So at that time, GDP growth rate was 4% a year, and job growth rate 2.4%. Productivity 1.6%. Fantastic. Much better than the US average. And right now, let's look at the recent 2 years, 2024, 2025. California GDP growth is 2.8%, slightly better than US. But job growth rate is 0.6%, slightly worse than US. And let's compare California to our own history. So we are, just remember, right now we are in the middle of AI boom, right? We are in the epicenter of AI boom, but why are we doing worse than tech boom before the COVID? Yeah. So, but on the other hand, you can say, yeah, it means our productivity actually is rising, 2.3%. So I'm gonna explain more detail today. So right now, in the age of AI, I think as an economist, this is the biggest question we try to figure out the answer, whether AI is gonna replace jobs or it's gonna augment labor jobs. So that is the biggest question, right? And you heard the optimistic view, pessimistic view. And I think the truth is in between. And right now, based on the data we are looking at, I think we are seeing a little bit both. So here in this chart, I show you this so-called white-collar job, office job in the United States. So this is 3 sectors. It's a professional and business service sector, financial activity, and information sector, including entertainment and some kind of big tech sectors. So basically, you can see in the history, usually in the expansion period, this white-collar job expand very rapidly. But over the past 3 years, we are seeing decline, a little bit decline of these white-collar jobs. And some people say, oh, we are just doing some kind of adjustment because we overhire in 2022, 2023, right? So that could be true. So right now, let's look at California. So this is California, the same thing, white-collar sector. So we have seen even deeper decline. So right now, the white-collar sector job actually is lower than the pre-pandemic peak level. So what is going on? So I think later I will show you another indicator. So right now there are two things here. One is maybe AI is slowing down some kind of corporations hiring for this white-collar position, especially entry-level position. And at the same time, especially for big techs, right now they are in the middle of this kind of biggest competition in their history. They cannot lose the AI competition with other competitors and with China. So they are spend all the money they have to do this investment, AI investment. Clement was talking about $650 billion this year. And they need to have the cash. So they decide to kind of save the money from slowing their hiring or laying off workers. So let me give you the evidence here. So this is a index job posting index. So the index is benchmarked in February 2020. It's 100. So right now, this is the latest data on March 27. So you can see if the index is higher than 100, that means compared to pre-COVID period, this position is having more kind of demand. Like on the left is physicians, surgeons, civil engineering, personal care, home health, pharmacy, electrical engineering. All right, so they are doing well. They had more hiring. And in the middle, nursing, management, banking, and finance, kind of similar to February 2020. But on the right, did you see that? Software development, this is software engineering position. They used to be the hardest position, hardest major in college, but right now they are not doing well. So that may be somewhat related to AI development. All right, let me give you another evidence here. So here in this chart, I show you this payroll job growth rate for 2 periods. So you see this blue bar, that is the annual compound growth rate from January 2020 to January 2026. So compared to the pre-pandemic peak to right now latest data, so how much each year this metro payroll job grows. And the black line is just looking at the recent 2 years. So blue bar you can see is a long-term growth, and the black line is a short-term growth. So on the left, this the highest growth cities are Austin, Raleigh, Columbus, Charlotte, Las Vegas. So like Austin, for example, you see this blue bar, 3.5%. That means over the past 6 years, every year, the job growth in Austin is compound 3.5%. So that's a lot of job growth. But even in the past 2 years, still very decent growth, 2%. So here you see this 6 pink arrow, that is California Metro. So the highest metro, I didn't have a Sacramento, but I think it's similar to Inland Empire. So Inland Empire is doing the best, all right? So either short term, long term, they are doing well. And then we have San Jose, which is Silicon Valley. They are not doing well. They are not increasing job at all. So that is kind of a little bit surprising, right? Because we all know these big tech, they are making tons of money, right? And they are not hiring at all. And then looking at Los Angeles County, kind of almost no growth. San Diego is doing slightly better in terms of long-term 6 years. And then we have Orange County here. So Mark probably will explain what's going on in Orange County later. And San Francisco, which is actually the epic center of AI, but they are reducing job totally in the short term and long term. And then the recent news about Meta, you know that they're laying off 8,000 workers, which is 1/10 of their total payroll. Why is that? Yeah, because they need to invest probably $200 billion this year, right? All right, so right now, let me kind of talk about this another big issue facing California economy. So in this chart, I show you the major 12 metropolitan area in terms of their nominal home price, case-shiller home price index. So this index is kind of benchmark to 100 in 2000. I think it's January 2000. So you can see across these 26 years, we have experienced this high growth in the housing bubble and the housing crash, and then we grow again. And you can see this variety of growth rate for these 12 metros for all kinds of national, local demand and supply factor. But among these major metro, the metro with the highest growth rate, nominal home growth rate, is here. Is Los Angeles and Orange County. So you can see the top blue line is us. And then San Diego is very similar. Miami is also very similar. So you can see because of this natural amenity, this geographic location really benefit the long-term home price growth. And San Francisco is a little bit in the middle, 260%. So basically, Los Angeles, over these 26 years, the nominal home price increased by 347%. That is like a 6-7% annual nominal growth, compound every year for 26 years. So very good. And at the bottom is Chicago. But I want to mention to you, this bottom number 3, that is Dallas, that is Texas. So did you notice actually Texas had great demand growth, this job growth. But at the same time, they also had a lot of housing supply growth. So basically, we didn't see a lot of home price growth in Texas. So by and large, if you are investor or you are a homeowner, you really enjoy this housing boom, right? But at the same time, for those first-time home buyer, young generation, they are facing this kind of affordability issue we all know about. So in this chart, I show you this. So basically 50 states in the recent 2024 median state income and median home price. So in terms of this median household income, how can they afford the median home? And I use this latest mortgage rate, 6.2%, 30-year mortgage, 10% saving down payment, and this is the ratio. So basically, this ratio is how much with this median income, household income, you need to pay for this median home in terms of mortgage. So California is number 2 in terms of least affordable states, following Hawaii. And then New York, Florida, they are more affordable. And we have this 30% dash line. That is like the ceiling of affordability, based on some kind of formula. And Texas is kind of more affordable. And why is that? I think here, let me try to explain. I think you guys probably are not surprised to know that housing supply play a very important role. So this is the annual building permit, like home supply for these 3 major states. The blue line is California, the red line is red line is Florida, and the black line is Texas. So you can see in the recent year, basically Texas with smaller population, they are producing double housing supply than California. So no wonder our home price are so unaffordable. And you guys know that our government had this goal, right? We are gonna try to build produce 2.5 million new housing in California by 2030. So what does that mean a year? That is 500,000. So right now we are doing just 1/5 of our goal. So of course we cannot achieve that, but I think with this C-core reform taking effective this year, I think we are going to see a little bit kind of improvement in terms of our housing supply. And some people had this kind of idea. So, all right, we are California, as you know, we are losing population over the past several years, right? So we are not like Texas gaining population, so you need to build more housing. So in California, we shouldn't build house because we are losing population. What for, right? But I kind of provide this counter argument. So here, this is interesting. So here I just show you these very basic two variables. So in this chart, the blue line is the housing price index in California, like I think it's year-over-year growth rate. So you need to look at the left axis, all right? And the red line is our California population year-over-year growth rate. You need to look at the right scale. Okay, so you can see some kind of up and down in the 90s, you know, when economy was not doing well, the home price decline. But here, I would like to zoom in on this part. All right, so this part, in the early 2000s, did you see that blue line increase, right? That is housing boom. So at that time, as I showed you before, the housing price in California skyrocket, right? So homeowners are very happy. But did you notice that at that time, the red line, the population declined. At that time, economy is doing well, but population was slowing down, not declining. It's kind of still above. The dashed line is a zero population growth rate. So population is slowing decline. Because why? Because we all know if you ask people who moving out of California, why is the main reason? It's cost of living, cost of housing, right? So it went up. And then amazingly, this is something I think a lot of people do not know that, is after 2005, 2006, housing market crash, right, in California, deeply. And then did you see that the red line increase? Population growth in the middle of a great recession. So what's going on? So my hypothesis is very simple. When the housing become more affordable in California, you are gonna increase the population, controlling for other factors. And then let's kind of look at the right. After 2015, again, home price was doing well, going, and then population growth started to decline again. And then we just basically hit the negative growth rate. So I will say, of course, we don't want to see another housing crash, right? Actually, some people are waiting for that to kind of buy low, right? But why don't we just try to provide more housing supply and make our housing more affordable? So compared to other states, relatively, and then we will be able to prevent further out migration and attract more young people to California. All right, here, so let's look at the sector job growth rate. So here, this is California. So here there are three bars, right? The blue bar is just the job growth rate in this sector over the past year. And the orange bar is the compound growth rate, annual growth rate over the past 2 years. And the green bar is the annual compound growth rate over the past 6 years compared to the pre-COVID period. So you can see number one sector is the healthcare and social service. They are doing well, producing jobs, very good. But in terms of their pay, their GDP valuation, it's not like high. And then we can see all the way to the right. So this is a little bit alarming in California. So manufacturing sector, we are losing jobs. And information sector, we are losing jobs. One of that is entertainment industry. We are not doing well. But a big chunk of that is big tech. So actually, I look at the data in California. This information sector, in terms of GDP sector, GDP actually in 2024 and 2025, in the middle of this AI boom, their real GDP growth rate is 10% a year, doing well, just like a tech boom in the before the pandemic. But they are, they are not, they are losing the employment. Anyway, I would say that is probably due to this AI kind of two factors. As I say, they need to make some kind of adjustment. All right, so here, let me show you some kind of geographic difference of growth. So this is annual average growth rate, compound growth rate of nominal taxable sales. So we try to understand the consumption spending for residents by county. So from 2019 to 2025. So California as a whole, on the nominal annual growth rate of the spending is 4.2%, all right? But because at the same period, CPI inflation is about 3.9%. So basically, you can say in this chart, the orange color is like they had a kind of positive real taxable sales growth rate, and the blue color is a little bit lower than the average. So Los Angeles and Orange County, they a little bit lower than average. No actually real increase, and Bay Area also lower. But you can see the inland California, they had higher growth rate. And why? Yeah, because of lower cost of housing, right? Low cost of living, so they had more opportunity to grow. So and you can see, yeah, up and down California. So this is a similar pattern. All right, so conclusion. So California had a stronger output growth, but weaker job growth than the nation. Despite the AI boom, California is growing more slowly than its 2010s tech boom. And I believe one of the reasons is because of the cost of housing is really kind of surpassed this kind of ceiling normal middle class can afford. And so it became the barrier of our California economic growth. However, we are still very optimistic, just like our U.S. economic forecast. We believe, with this kind of sequel reform, and we are gonna do better. So yeah, actually our forecast is kind of like we are gonna return to this 2010s tech boom period. So our forecast for payroll job over the next 3 years, this year is still getting by 0.4%, next year 1.4%, and 2028 2%. Unemployment rate will go down to 4.4%, and housing building permit will increase from this year 111,000 to 125,000 in 2028. Although it's still way below than our ideal target, but I think it's an improvement. So that's my presentation. Thank you very much. So right now we're gonna have Mark to talk about Orange County economy.
Okay, good afternoon. Let's see. Oh, the title's up. Okay, I've got a long title. Don't normally have titles that long. Yeah, new development, healthcare, manufacturing carries the economy into 2027. Okay, that's about all you need to know about the Orange County forecast. So if you nod off due to the heavy lunch we've had, you've got the gist of it. Now, William talked about population declining in California, and it's declining in most counties along the coast, all right? And Orange County is no different from that. And so it has been declining since 2018 here. And I just wanted to show you this. You probably already know this, but this kind of underscores some of the things I'm going to be talking about today. It did blip up in 2024, and that was due to the surge at the southern border and a disproportionate share, of course, coming into California at that time. But then the border's closed now, and of course it went back down in 2025. Probably will continue going. Our forecast is for it to continue to decline. Okay, but keep that in mind that it is in decline. And that's not a temporary situation. Let me talk a little about the labor market, because I think this is the most unusual thing, and Clement talked about it, and of course, William did too, because it is a bit unprecedented, and we're not seeing much job growth at all. And this is annual numbers from 2014 to 2026. Now, in 2026, I only have 2 months of data in the books, so it's a little unfair for me to include that, but that's the pace that it's at in 2026. That's that rightmost bar. So these are the last 4 years, including this year. And actually, here are the numbers, if you want to see that. But we've hardly had any job growth in California in the last few years, and certainly the case is Orange County. In fact, it was negative last year, and the pace so far for the first 2 months is it's running negative this year. All right, and now it's unprecedented in the sense that we're seeing this low employment or negative employment, and it's not a recession year. In fact, as Clement said, we've got actually decent growth in the economy. So, you know, and we all kind of know why that is the case, but I want to kind of talk about this a little bit. Here's the unemployment rate for Orange County. It's currently at 4%. It has risen, as you can see, over time, but it's still low. In fact, it's close to full, if not full. So we have this conundrum then, and that's low unemployment and low growth of jobs, right? And so Clement talked about this a little bit, and I want to give you my own take on it, the conundrum situation. Here's unemployment rate by age group in California. I would have done this for Orange County, but they don't do it. If they give me California, it's going to be very similar to the case. So this is 16 to 24-year-olds, and the unemployment rate currently is 14.4. Now here's everybody else, and the unemployment rate is 4.4. All right, so you can kind of see what's going on with the labor markets here. In fact, we're seeing this divergence between the younger age group, this is basically Gen Z, and everybody else, pretty much all of us in the labor force. And this has really started to diverge end of 2022, beginning of 2023, when the generative AI started to come out, start to make a difference, even in the workplace. So we saw chat come out on November 30th, 2022. We saw Bard come out, later known as Gemini, which is today. And then we saw Bing chat come out. That's later known as Copilot. Okay, and so they started to make a difference in the workplace at that point in time. So here's my explanation, which sort of dovetails with Clement. We have a much lower labor force today than we had 7 years ago. All right, well, not much lower, but lower. So that's kind of unusual. And the reason for that is because one of the reasons, the first reason, is because the population is contracted. All right, which you've seen. And the reason for that, of course, is because of housing affordability, which William talked about. Okay, now AI has displaced a lot of job opportunities in the workplace, and most of these are entry-level jobs that employers don't need to fill. Okay, so that's why we have this relatively high rate for this age group, 16 to 24. And by the way, 16 to 19 is 21%. All right. So a lot of these, a lot of Gen Zers get discouraged, and so they drop out of the labor force, lowering the labor force further. And you can see that in the unemployment rates statistics that monitor discouraged workers. All right. So labor force in Orange County, which is now here, is lower than it was before the pandemic. All right. And that is what's keeping the unemployment rate a lot lower than it would be. So let me give you my overall summary of where Orange County is. And we already talked about no job creation. The visitor industry, which is, of course, big here, is pretty stable. All right, and I'll show you some evidence of that. Industrial real estate market has slowed down. Okay, I don't think it's worrisome, but it has slowed down. We're all, on the other hand, the office market, which has been worrisome and has been very slow in recent years, is gradually improving. So we're seeing this opposite situation now occurring. Healthcare sector, which I talked about at length last year, if you were here, is expanding, continues to expand, and then new development in the region is continuing to be the engine of growth. All right, even though it's slowed down a little bit here. So healthcare, new development, that's really what's powering the economy here. Also manufacturing, I'll talk about that in a minute. Here's industrial real estate. And here's the availability rate. It's currently at 8.1%. Vacancies at 5.2. Everything started to change very quickly right around mid-2023. What happened in mid-2023? Well, that was when we've had significant new completions and delivery to the market of new industrial space in a frenetic fashion. Okay, so we had supply growth exceeding demand growth. Demand is still there, but we just had much faster supply growth, which has caused availability and vacancy rates to rise right now. We're into 2026. That's the completions for the first 3 months of the year. There will be more this year as things of course finish up. Here's the office market. And office availability rates have been in decline the last year, 18 months. And same thing with the vacancy rate. So we're at 11.5 in Orange County and 14.3. All right. So when I compare this around the state, and I just focus it on Class A and B because that's what that's what the brokers tend to monitor on. Whereas I showed you just the CoStar data. Here was a year ago vacancy rates for office, and here is current vacancy rates for office. All right, and there has been improvement. So here they all are. Oh, I didn't realize they're all separate there, but we've got 3 ups and 4 downs and 1 the same. And Orange County has improved significantly in the Class A and B space. And so it's a mixed bag, but nevertheless, the office market in general does seem to be improving, not in some of the real big metro markets, but in other markets of California right now. Okay, it's helpful to have office using employment not go down. So it's remained relatively stable in Orange County all the way through our most recent data point, which is February. All right. However, the office market does face some new challenges now that it's finally improving, and that is we've got AI taking over a lot of jobs, and it just so happens that tends to be office using jobs. So yeah, we haven't built much office space, but now we may be losing employment numbers in the office using arena. So we're kind of watching that very carefully here right now. Here's the jobs created by sector in Orange County all last year. All right, and William talked about healthcare. That's the big 800-pound gorilla in the room in terms of job creation. In fact, they're about the only sector that created jobs. Them and the visitor serving industry and resident serving industry in food services and things like that. So leisure hospitality. So that's it. When you look at everything else, it's all negative. All of it. Okay? So every other industry is shedding jobs or contracting right now. Are we seeing it because of layoffs? Not necessarily. Yes, layoffs are up a little bit. In fact, that is 2024, 2025, and here we are year to date, 2026. We're a little bit at a faster pace in 26 than we were in 25, but not by much. But that doesn't explain, where all these jobs are. We're just simply not hiring like we used to. You don't have to necessarily lay everybody off to get to the same results. Here's the layoff surge in 2025 and continuing into 2026 that we're seeing in Orange County by industry. And the big one is retail. Now, some of my numbers got askew, but you can see retail, 3,500 of those 6,000, so more than half. Amazon was responsible for half of those. Does anyone know why? Huh? Amazon Fresh and Amazon Go. Okay, Amazon is going to leave everything to what? Whole Foods, shutting down those stores. So that they let everybody go. Then we got wholesale trade, tech. These numbers are healthcare. They kind of got all messed up. And then amusement and recreation. So these are all sort of the usual suspects in terms of AI. So you've got wholesale trade and tech, even healthcare, which was the leader, actually had some layoffs too. So AI is responsible for a lot of the layoffs, but not all. All right, there's other things that are, of course, going on, and you can't really blame it all on just AI. Here's manufacturing, which I said was relatively strong here, and I'll show you some evidence of that. But when if you look at the employment picture, and the yellow line is all manufacturing, it looks very weak. And then the blue line is what we call advanced manufacturing, and that's dealing with computer electronics, medical devices, aerospace parts, components. So the more high-tech manufacturing. That represents about 40% of total manufacturing, and that has been declining in sync with total manufacturing. So you look at this, and of course, it looks weak, right? Well, if you look at the Chapman Manufacturing Index, which monitors production and new orders for manufacturing products by a survey of producers in Orange County, well, that's actually been rising, gradually, but rising. And now we're at the highest level of the index since 2022. All right, so manufacturing seems to be doing very, very well, relatively speaking, in spite of the decline in jobs. And of course, Clement spoke to this same issue. Anything above 50%, by the way, in this index is expansion. All right, so you can see manufacturing has been expansion during the entire time period that jobs have been contracting. Okay. Same thing with tech. What's tech? I've shown you this before. Computers, software, data processing, scientific technical consulting, etc. All right, and so it's a composites industry, and it has lost about 7% total from its peak of jobs over the years, over the last 2 or 3 years. Again, this started right around the time of the onset of AI, generative AI processes that started to originally take over a lot of jobs in the software coding field, because if anything that it did well in the early going, it did code. It's much better now at a lot of things. And yet tech, if tech was weak due to its employment situation, you wouldn't see venture capital attracted to Orange County in the tech field, but it has been. It's not as high as it was in 21 and 22. Of course, those were record years for the United States venture capital market and California, but it's still eliciting lots of direct investment into tech here in Orange County. So you have manufacturing still climbing, venture capital still climbing, and as William said, it was responsible for about 10% of total output. And so let's take a look at gross county product for Orange County. Here is the blue line, which is U.S. GDP in real growth numbers. All right, and the orange line is Orange County, right? So Orange County has been frequently above the U.S. in terms of overall growth over the years. And then most recently, particularly when we've seen all the employment decline, it's basically moved right in step with the U.S. A little bit lower in 23, a little bit higher in 25, 24, and about the same in 25. So again, you can't judge a book by its cover. You can't judge the economy just based on where employment is going. Okay, so the productivity of AI has come through and has produced lots of output, value of goods, value of services in Orange County. If I look at hotels, which of course monitor tourism, visit and business visitors, it's a boring chart, very boring. This kind of moves lateral, but that's good news. It shows the stability of the industry. Actually, it's been growing because even though we're in the 70 to 80% occupancy rates over all this time period in Orange County, we've added 3,000 to 4,000 new hotel rooms during this time. So the supply has increased, but utilization has been the same. So tourism is doing quite well. It's not declining in any way. It's not necessarily rising significantly either. So it's a very stable industry. You can tell that from the number of deplanements and enplanements at John Wayne Airport, which is basically stable as well, staying about the same over the last 3 years. And then, of course, I like to monitor Disneyland attendance because it kind of is one of these indicator species that show you how tourism is in the area. And it's hit a cap of about 17.2 million people per year. Kind of stays right there, hasn't really changed much, going all the way into 2025. And if I look at the wait times, which I've been known to do in order to get an idea of where things are within Disneyland during the year I'm reporting on, they really haven't changed much either. 20 to 30-minute waits over the last 3-4 years. So again, not much change at all. The only thing that really changed at Disneyland is the price. So, but the last year, the Southern California residents got a deal. They got the local deal, and so you could go to the 2 parks for 3 days for only $249. Okay, which is a big savings apparently. Let me talk about housing. All right, sales are slightly higher this year in the existing home market, not much, but maybe that's because there's so much more to choose from with inventory being 30% higher. Selling values are an all-time high. Needless to say, don't need to tell you that. 1.43 million was the median selling value in March. Okay, and price appreciation over the last year, and even before that, has been less than general price inflation. I think it was about 2% last year. So actually, in real inflation-adjusted terms, housing prices are coming down slightly, but they're not really going up. Okay, apartment market vacancies at 4%, was a lot tighter. It's kind of loosened up a bit with a lot of apartments coming online. Rents are at an all-time high, but appreciation is cool, just like the purchase market. All right. In fact, they are actually rising rents at a rate lower than inflation as well. We have 5,600 apartments under construction at this moment, and that's not as many as we've seen. In fact, you can see the decline over time, but this is going to ramp back up. Okay, a lot of apartment construction in Orange County. This is going to ramp back up. We look at it because we look at the permits, and the permits the last 4 years have been relatively constant. Okay, so they've risen, and most of these are multifamily or apartment complexes. So we have 6,000 to 7,000 units per year being permitted in Orange County. 64% are apartments. We've got 24,600 units in the queue for new development. Most of these are in Irvine, Santa Ana, and a lot coming out of Rancho Mission Viejo. Okay. In fact, here are some of the key projects. Now, I'm not going to go into these. You can look at it in the book. We've got a full development section, as we always tend to do, because it's such a key driver of this economy. But these are the large projects. They're all under construction except for the last one. Village at Santa Ana is still in the approval process. And Related Bristol, just before that, is about to break ground this year. But the rest of these are underway. Hive Live is off the table now, apparently got sold, and it will probably go back to being an office campus, but we'll see how that all. But you can see these big projects are all underway right now. And this is what's kind of driving the housing. I got more housing even on the mega projects that are under construction, which include OC Vibe. Disney's going to finish a new 900 unit hotel complex this year. Tustin Legacy, started by Irvine Company, 3,000 units. That is has already broken ground. Warner, Red Hill, and Santa Ana is just about done. They're adding 300,000 square feet, et cetera, et cetera. Disneyland Forever broke ground. All new stuff. And then Bolsa Pacific, which is a redevelopment of the Winchester Mall, 2,200 homes. So Again, lots of activity. Let me give you the forecast. Expansion of new development, which seems to be very prolific right now, is only going to it's going to expand. It's like I say, it accelerates going into 2028. There's a lot of pressure to finish stuff before the Olympics, like Ziman. So that's gonna help with overall development. Housing starts are likely to remain about the same from year to year. Okay, so I don't think we're going to get a lot of extra housing. William talked about that with respect to California. It might go up if we get CEQA revision. Then yes, maybe. But in absence of that, I don't think anything's going to change. Continued population decline. We do have that. So continued probably labor force growth decline as well. The visitor industry is going to stay stable or maybe grow just modestly this year. The overall employment forecast is our biggest uncertainty in the forecast. Healthcare is probably going to be the biggest sector for growth, continued growth. It's been so dominant. But we do believe that tech consolidations will level off. I think Clement mentioned this. Net overall growth this year is going to be, and next year will be similar to what we've seen last year. So here's the gross county product for Orange County, and we have about 2% growth in the next couple of years. It's slightly lower than it maybe has traditionally because we don't have any job gain. So that kind of produces a drag overall on growth, but not much. Our job creation numbers, that is 2025. And so 2026, we actually do have some positive gain this year and next year. The forecast models for Orange County do utilize the UCLA, California, and U.S. forecasts. They have positive job growth for California in their forecasts. That has a spillover effect on Orange County. But I'm very, very uncertain about this. And the numbers that I have are within the interval of the forecast error. So we could end up with no job growth. All right. Here's some numbers. Unemployment rate 4.2, not much, goes up a little bit. Employment growth, 0.5%. Healthcare jobs, another 2,000. Gross county product, about 2%. Residential units, close to 6,000. So again, more of the same that you saw in 2025. So if you liked the 2025 economy, you'll love 2026, okay? But again, just one caveat, last thing I want to say. We're much less certain of that employment forecast because it doesn't incorporate all of the performance improvements in AI that we're witnessing now in the workplace that could replace jobs even at a faster rate, at least for the next year, maybe two. And of course, we may see more jobs after that because the surge of AI investment will not be quite as what we're seeing right now. Okay. Okay. Went wrong way. Everything I just talked about is in the book, which is hot off the press. Just finished it yesterday. So volume 23, that means we've been doing it for 23 years. All right, 100 pages long. So take a look at that if you want more details on what I just talked about. And that is it. Thank you.
All right, thank you, Mark, and thank you, William, for those excellent economic forecasts. The UCLA Anderson Forecast has collaborated with the law firm of Allen Mackins, where we produce 2 times a year a commercial real estate survey for California, and we're lucky to have Spencer Kallick with us, a partner at Allen Mackins, who's going to give us an update for the most recent survey results.
Good afternoon, everyone. It's a pleasure to be with all of you. I am batting cleanup. I stand between you and a bathroom break or some coffee. But I do have some late-breaking additions to Mark's survey. It was my daughter's 7th birthday on Monday. We went to Disneyland. It was very long waits, Haunted Mansion was about an hour and 20 minutes, and I did stand in that line. And 2 stuffed animals and a magnet was $89.19. So Disney's doing great. My wallet, not so much. So my name is Spencer Kallick. I am a partner at Allen Mackins. I'm our operating partner. I'm a real estate and land use attorney, and I have the pleasure of being the chair of the UCLA Anderson Allen Mackins forecast, which is a forecast we've been doing for several decades now, looking at sentiment of commercial real estate across California. A lot of what you're going to hear tracks with what you've heard already today, which is that the survey points that a market is in transition right now. It's not quite distress, it's in transition, we're going to call it. And I would emphasize the word measured optimisms. Respondents are not signaling a broad-based boom, but they are showing greater confidence in the environment is becoming more understandable and more financeable and than it was in prior periods. And so I would say we're having some cautious stabilization. That means that the markets have not fully normalized, but many of our participants surveyed now believe that the worst is behind us. They are seeing improving clarity, which is important because capital tends to return first when underwriting assumptions become more dependable, even if pricing and rent growth remain moderate. And we're looking at some selective growth, which we'll talk about as well. I will also just say I am not an economist. I did not do great in econ undergrad, so I am not going to show you a bunch of charts. You already saw a bunch of charts. I asked for some pretty pictures when they were making this, so let's see how we did. Oh, that's pretty. Multifamily continues to be one of the more resilient sectors in the survey. In Southern California, vacancy rates in LA, in the Inland Empire, are expected to decline at roughly the same pace as the summer survey a year ago. Orange County and San Diego are expected to tighten more gradually. And in Northern California, vacancy rates are expected to continue falling across San Francisco, the East Bay, Sacramento, and Silicon Valley. Interestingly enough, I was there 2 weeks ago when I talked to a couple of my large apartment operating clients. They're talking about 20% rent growth in the city of San Francisco, which is pretty darn good. And I'm guessing a lot of folks would be happy if we could have that here in Orange County as well. Now, I'm a land use attorney, which means I always get asked about, well, we did all this CEQA reform and we have passed all these new state laws. Doesn't that mean you're going to build a ton of housing? And you saw some of the numbers today. What I can tell you is it's a mixed bag. I have on my desk alone about 20,000 multifamily units in various states of entitlement across the state. It's a lot of housing. Don't ask me how many of those are going to get built. Some of my clients are in the room. Maybe they can answer that question. But what I can tell you is the state laws, to be blunt, were a lot of great headlines and not a lot of great action. We are still not seeing the kind of massive CEQA reform that we need. You'll probably see a ballot initiative on that in the next election. And a lot of state laws are helpful and they have the right sentiment, but they are still a lot of gray areas and things that need to be modified in years to come. In the industrial sector, overall industrial vacancy conditions remain among the strongest asset classes across the state. Sentiment was even more positive than our summer survey. 54% of respondents reported they are planning at least one new industrial project in Northern California, and a lot of that is led by what you would expect, e-commerce remaining strong, and we're actually starting to see a lot of new iOS deals come back. Went out of fashion, now coming back again. In the retail sector is also showing stronger growth than many would have expected, especially given how challenged the sector looked a few years ago. Developers are continuing to focus on neighborhood serving retail and service-oriented tenants, which is an important signal that local convenience and experiential relevance remains critical to performance. And even though I get home every evening and see a box of 50 Amazon packages that my wife may or may not have ordered, we're still going out on the weekends, as many of you are as well, to kind of pick up those experiences while we're shopping for retail. Has anyone been to South Coast Plaza recently? You should go do that. Office sector. Overall sentiment in the office sector varies across California. Developer sentiment is optimistic in San Francisco, Silicon Valley, Orange County. The East Bay, LA, and San Diego has been I'd say, borderline. And anecdotally, we're hearing about San Francisco as the hottest office market. I think a lot of people in here wish that they had bought office a couple years ago in San Francisco. I know, as an example, we just closed on the Oceanwide Center, which is not the graffiti towers in downtown LA, but is actually the big, basically, ditch that was dug before Oceanwide went belly up in the center of San Francisco. And our client's going to go vertical on a 60-story Class A office tower that we are going to be moving forward with an anchor tenant in tow. So regionally, looking at Southern California, retail sentiment improvement indicates better confidence in consumer-facing formats, particularly where retail is tied to daily needs. Office remains challenging, which is consistent with the broader statewide story, but that challenge is uneven and highly dependent on location, building quality, and demand profile. Industrial, again, super strong, probably the strongest story, supported by tightening vacancies and durable logistics demand. Thank you to my wife. Multifamily also remains positive, though again, depends upon rental growth. So different story in San Francisco, 20% rental growth, whereas LA, Orange County, a little bit less. Northern California, also seeing retail sentiment being positive and improving, suggesting more confidence in consumer-oriented assets that many may assume, especially in the right locations. The office point is new office. Again, we talked about new office going up like hotcakes in San Francisco. Northern California is seeing rent growth that we are not seeing here in Southern California. Industrial in Northern California, again, appears to be outperforming, supported by strong demand and low vacancies. And multifamily resilience is another important stabilizer for the Northern California region. Key drivers, you've already heard a lot of these already today. AI, which need data centers and digital infrastructure, becoming increasingly meaningful forces in commercial real estate demand, especially for industrial and specialized asset classes. E-commerce remains a foundational demand driver, though now as part of a broader digital infrastructure story rather than just a standalone trend. The number of data center projects we're doing driven by e-commerce is also really interesting. And lower interest rates, hopefully improving sentiment is also critical. Again, this survey was done before some of the things that happened across the world, but even modest easing in the rate environment can unlock more confidence around financing, pricing, and development feasibility. So for investors, developers, lenders, advisors, the implication is clear. 2026 may offer some real opportunity, but that success will depend upon selectivity, timing, and market-specific strategy. I want to thank all of you for joining us for this first kind of round of chats today, and welcome to continue the conversation. Feel free to shoot me a note, or we even started a podcast called Real Smart, and come check it out at the QR code on the screen, because everyone's got to have a podcast now. Why not? Thank you all for joining, and it's a pleasure to be with all of you. Have a great rest of your afternoon.
So up next, we have a panel on real estate. It is hosted by the Paul Merage Business School here at UC Irvine, and we have Ed Colton, who is going to lead this panel. He's the director for the Center for Real Estate at here, the UCI Business School. So thank you, Paul.
Thank you, Clement. We're not going to talk about real estate. Even though I am the director of the Center for Real Estate at the Paul Merage School, that's not my role here. My role is as a liaison between UCLA Anderson School and the faculty, the general faculty of the Paul Merage School of Business. And so for the past 3 or 4 half-decade or so, what I've done is invite my Merage School colleagues to discourse upon a topic of interest. And I'm always so tickled about, because I'm always so proud. I'm just so like, I must be a really good person because I'm colleagues with these really fantastically and scathingly brilliant scholars. And today we're going to talk about disruption. And I'm going to, even though their titles are all up there, I'm going to introduce them because there's actually a correction to be made. In the middle is Violina Rudova. She is the professor of strategy and entrepreneurship and the Dean's Leadership Council chair She's also the Associate Dean for PhD and Doctoral Studies and Research at the Paul Merage School, so she's very important. On my immediate left here, John Turner is an Associate Professor of Organization, I hate our area names, Organizational and Digital Technologies. Sorry. Operations and, it just says O on here. Operations and Digital Technologies. And on the my far left, Patrick Bergman, it says assistant professor, but he has been promoted to associate professor of organization and management. And I'm just so pleased to have them up here with me. As I said, the topic is disruption. And risk and uncertainty, and we've heard a lot in the previous hour and a half about the risks that face the economy, the risks that face firms, and how do businesses, how do establishments deal with the risk and uncertainty and disruption that we have seen. And so my colleagues here have a common theme in their research, which is how firms engaged with the disruptions caused by COVID. But the lessons that we learn from reactions to COVID maybe have their place in discussions about how we react to disruptions today. So I'm going to ask them about their research and about their thoughts about dealing with disruption, and I hope you find it interesting. So we'll start with Violina. Violina, you've written a lot about the nature of uncertainty and the different approaches to dealing with shocks. Can you give us a general introduction to what we mean by risk and uncertainty and disruptions, and maybe how firms reacted to COVID?
Well, thank you, Ed, for the gracious introduction. I'm super excited to be here with all of you and to have an opportunity to just share a few thoughts on disruption and uncertainty. So I would like to open with something that connects everyone in this room, regardless of your market or asset class or role in the industry. So I'm going to kind of rewind the time clock backward. And before 2020, when I was researching and teaching uncertainty in my classes, the general attitude was that this was kind of a peripheral topic, or maybe a little esoteric, something that academics do, or maybe scenario planners, but certainly not people who run companies and have like clear strategic plans and close deals. And I have to say that when COVID hit, and I'm glad that our panel is anchored in COVID, because when COVID hit, it literally overnight turned everybody into a futurist, because it gave us something that no textbook or like a professor who teaches uncertainty can give us, which is the personal, visceral understanding that the future does not have to look like the past. And that is probably one of the most fundamental aspects when we think about uncertainty, that it refers that we're really thinking about change that has altered in some fundamental ways the underlying dynamics of relationships and structures, and we cannot proceed toward addressing uncertainty essentially thinking that the past is a reliable guide for the future. So if you think about sort of like from what happened in real estate when COVID hit, right? I'm by no means an expert at all in the industry, but just some, general impressions. Essentially, office buildings, which are the backbone of commercial portfolios, sort of suddenly confronted a question that no one has ever probably modeled in some depth, which is what happens if people are not required to come to the office, right? And that's sort of the kind of fundamental shift that uncertainty introduces in what otherwise looks like our familiar environment. So how did we move forward under uncertainty? Essentially, we adapt, and we adapt naturally, but in some ways, we continue to believe and yearn to the return to the normal. I'm sure you all went through the period when you waited for us to return to the normal. And did that happen? not exactly. So what actually sort of was manifesting in the period in which we're thinking about returning to the normal is one of the big challenges of navigating as a strategist and a leader and an entrepreneur in the space of uncertainty is that our natural cognitive default is to be anchored in the past. Psychologists call this anchoring bias. And this is the gravitational pull that creates what Peter Drucker, the father of modern management, called yesterday's mind. So I'm going to highlight the idea of yesterday's mind because I would argue that this is the single most dangerous trap in navigating uncertainty is yesterday's mind. So what are some examples? Like how do we move forward? Let's kind of look for a moment at the restaurant industry because it's kind of a bit of an analogy and we all can relate to the experience. So what did restaurants do when COVID hit? They didn't just wait to weather the storm. They actually repurposed their assets, their facilities to provide fundamentally different services. They became grocery suppliers. They provided meal kits, ghost kitchens, all of which are actually fundamental shifts in how they thought about their business model, starting from how to use their assets, what supply chains they link to, and how to rethink their relationships with their customers. So that exemplifies essentially how we adapt to uncertainty, not by kind of modifying our frameworks, but really thinking about what needs to change in fundamental ways. And maybe one more thing I will add here is that I currently have a study on restaurants, among other things. And one of the things that we observe in this study is that those that are already kind of thinking about change, have ideated in their mind that they want to try a new format or experiment, actually were in a much better position to weather uncertainty. They saw it as opportunity. They moved faster as new information came and new resources became available. And they made more lasting changes that actually improved their businesses that went not like returned to the normal, but essentially to a different level than the normal. So maybe I'll pause here and pass back to Ed.
Sure. John, you've written about this distinction between prepping for specific risk versus prepping for more general risk. And I'm reminded of Donald Rumsfeld's distinction between known unknowns and unknown unknowns. Maybe you could talk a little bit about that because you've written and studied different ways that firms have dealt with different kinds of uncertainty and the steps they take to prepare for unknown unknowns.
Thank you, Ed. Absolutely. So I'm an operations researcher by training, which basically means that I study the optimization of business problems. Typically, what that means is trying to define the problem as analytically and as precisely as possible. So when we talk about like maximizing throughput or maximizing profit or maximizing any metric, we're really talking about like measuring that, and boiling that down to its constituent parts and figuring out like what variables impact those parts and so forth. And then explicitly modeling all of the constraints that might, constrain your throughput, your market size, your profit, or what have you. So I'm kind of coming from the approach that sort of side of things, and of course, modeling any kind of optimization problem where we care to, do the best over time involves a number of things. Not only a sort of a short-term, a long-term trade-off, and that's pervasive and comes back into things in multiple ways. But also uncertainty, modeling uncertainty also comes into play. And I think, when we think of disruption, right, like the biggest kinds of disruptions are these things like Ed mentioned, these black swan events, these unknown unknowns that you just don't see coming at all. But there are also kinds of disruptions like right now what we see with the tech industry building all sorts of AI models and companies that are adopting AI models. And we have some sense about what the AIs can do, and we might be able to plan that into our IT life cycle, or where the company's going strategically. So I want to frame it, the concept of what is a predictable uncertainty versus maybe a less predictable uncertainty in the following way. And I think the severity of the disruption is independent from whether we kind of can model it or don't model it, right? So for example, some work that I did some years ago was with a large retailer, and they were trying to figure out how can we negotiate better contracts with our full truckload shipping companies. And at the time, they were negotiating a base price and then a fuel surcharge onto that. And of course, the fuel surcharge is linear. It's a function of the diesel price at the pump. So as the diesel price goes up, the charge that the shipper passes on to the retailer goes up. And so at the time, they were looking to try and better share the risks of uncertainty of future diesel prices with the retailer. And so we looked at what can we do to perhaps bend the slope of that diesel price surcharge curve? How do we put a cap on it, and so forth, and so these kinds of things. So roughly stated, they understood that there was a source of uncertainty that impacted the business. That was the price of fuel, and then how can we manage that uncertainty? And maybe we do some forecasting to try and figure out what is the likelihood of that we have a high diesel price, low diesel price, this kind of thing, and that helped them negotiate with their shipping companies as to what type of a fuel surcharge they felt was acceptable, given a certain base price that they were agreeing to pay for the load. So there's many situations like that, and you can think that's pretty short term, right? But companies, airlines also run into large logistical issues in managing uncertainty. And at least coming from an operations background, the best example of an airline that was able to recover from a disruption is that of Continental Airlines. And although the example is over 20 years old right now, because we're talking back to when 9/11 happened, Continental was well known for taking less than a day to figuring out where all their planes need to be, where all the pilots need to be, the flight attendants, food service staff, how to comply with all sorts of FAA regulations about how long people need to sleep and rest and things like that, union rules and so forth, and get as many people flying as quickly as possible and on their way. Because as you know, during COVID, all flights across the country were stopped for an extended period of time. And it took most of the airlines weeks to fully recover from that COVID disruption. Continental Airlines was able to, within a day, figure out what the plan should be to totally react and optimally react to this disruption. And I guess the takeaway here is that they saved about $40 million just from that one event alone, compared to what at the time was more industry standard practices of not having an optimization system in place. So the takeaway here is, we might not know what's coming, but we can invest in systems, toolkits, software, knowledge, people, right, that are able to jump in quickly and react to whatever disruption we might not see coming, but we have to have the foresight to invest in that technology ahead of time. And then one final thing I want to say is about correlated risks, and that's an interesting point because, I don't know what the future may bring. I invest in my 529 accounts for my kids to go to college, but I don't know if the stock market is going to go up or down in the next 10 years, right? But I figure that if the stock market goes up, then there are also many people that have a lot of money to spend on education, so I want to be one of them. If the stock market goes down, then again, everybody's in the same boat, right? But the biggest risk is not investing at all, and others who did invest have all that money to spend on education. So, trying to figure out what your correlated risks are and invest accordingly, I would suggest. Thank you.
Thank you, John. Patrick, your research on COVID takes a slightly different turn. You talk about people's reactions to non-pharmaceutical interventions and similar kinds of restrictions. Can you talk about people's ownership of spaces and how they dealt with that during COVID?
Yes, absolutely. So just as COVID represented a massive disruption to organizations and businesses, of course, I'm sure we all remember it was a massive disruption to individuals, to communities. There was a lot of messaging all of a sudden that typical behaviors that we were all used to engaging in, like hanging out with friends, socializing, not wearing masks. Suddenly we were being told that this was problematic behavior. And so the question that I asked in this particular project that I'll share is, what predicts, or what communities, so we're looking at the community level, which communities were able to adapt to these kind of changing norms or changing behaviors that we were encouraged to engage in better than other communities? So you might imagine that there are, so you might imagine that certain things might predict this. So why do certain communities do this and others don't? It could be your political orientation, right? It could be demographics of communities or neighborhoods. It could be wealth, how wealthy a neighborhood is versus another neighborhood. So what we found was that it's actually none of these things were the biggest impact or were the biggest factor in the research that we did. What we found was the most important factor was territoriality. So what is territoriality? Territoriality, it's a sense of ownership over space. So it can mean, you own something. So if you own your house and you have people over, you feel like you can kind of dictate the rules of that space. You can set the rules, tell people how to behave, and we feel very comfortable doing that in a way that if you go to another person's house, you wouldn't feel the same way. So it's ownership of space, but it's also just when we feel like we control space. So this can take place not just in something we physically own, but a neighborhood park or the streets around your house or in your community, in offices. People tend to feel territorial or sense of ownership over their offices, which they don't necessarily own, but they're used to frequenting over and over again. So similar with bars or restaurants that people might be regulars at. So we found that this was the biggest predictor. So people in communities that had high levels of territoriality, and we measured this through a number of different factors, such as home ownership rates, longevity of length of residence, and some other factors. We found that those were the communities that tended to adopt these recommended behaviors. So they tended to be able to adapt and change more than other communities. And it wasn't just that they changed their behavior. So yes, there was more sheltering in place. Yes, there was more social distancing, but they also policed their communities as well. So they would report people if they saw someone who wasn't social distancing, who wasn't wearing their face mask. They would actually call, I don't know if you're familiar with 311 hotlines, actually report to the city. We did a lot of this research in New York City. They report to the city and say, hey, there's someone down the street, they're not wearing their face mask, can you come and intervene? So people feel empowered to police spaces when they have the sense of territoriality. And it also seems to lead to an ability to adapt and change, because when you have a group of people who feel territorial and feel like a certain change is necessary, then they're empowered to change themselves and also regulate and enforce that change. So I think there's, for me as a researcher and just in general, I think there's an interesting lesson about thinking about ownership of space and how we feel about physical spaces and our control of those spaces, and how that can potentially lead us to be more adaptable in conditions where there's a lot of disruption.
Before we leave COVID, John's done some fascinating research about how the NBA figured out how to deal with COVID as the playoffs approached. John?
Yeah, so thanks. Yeah, so this was an interesting project, actually. So I'm somewhat more of a basketball fan now than I was before. My son really loves basketball, and so he's getting me into that as well. But years ago, when COVID had started, one of my graduate students, who was a big basketball fan, we were working on a completely different research project, and he came in to my office and he said, I know I was supposed to be working on this other project, but I was so upset that the basketball games have been canceled or suspended because of COVID that I started working on this other model to try and inform sports leagues about how to recover from a suspension like this. And of course, there are many cases of suspensions in sports leagues. Most of them involve like player disputes, sort of contract negotiating disputes and things like that. So every 5 or 10 years or something like that, there is some kind of a suspension, and then the league might start late or may have fewer games than were normally planned. And so at the time that COVID happened, he was basically trying to, his idea was that we would like to be able to figure out what games that the teams should play, so that with having a much fewer set of games than a full remainder of the season after the suspension. Okay, so let me back up a second. Let me just say that the assumption was that the COVID wouldn't last that long, that at some point that the league would decide to resume the remainder of the season, right? Now, I know we're looking back, we remember things differently. We know that COVID lasted several years, right? But at the time, the plan was that, okay, maybe we'll shut down for a month or something, or 2 months, and then we're going to resume the rest of the season, and we're not going to have time to play all of the 259 games that remain, but perhaps we'll play half of them or something like that, right? And so what we did is we looked at how can we choose among those 259 games a subset, maybe 100 games, maybe 150, and we want to choose games in a way that will achieve an outcome that is as similar to the outcome that we would have had the entire full season being played out, right? And so the objective that we chose in this case was a similarity between the ranking that we get from playing our shortened season and the ranking that we would get if you play the full season, right? And of course, rankings are very important because that's how you know which teams did the best. They're also how you choose which teams advance to the playoffs and which teams get first-round draft pick, and so on and so forth. So the idea was create an optimization model that selects the subset, these 100 teams, 100 games out of, let's say, the 259 that are remaining, but do it in somewhat of a fair way, right? So fair way here means that, every team has to play the same number of home games, the same number of away games, and so forth. And I think what was interesting out of this work is that, if there are many analytics projects that I worked on, analytics projects that typically take the form of you use data to predict certain outcomes. And then you leverage those predictions to take actions, right? So in this setting, the predictions are essentially who do we think is going to win each of those 259 games, right? If those games were played. And then we select out of those 259 games, say 100 games, right? Which games do we pick, right? Now, at first glance, you might think, well, hold on a second. If you're predicting who's going to win each game, and then you're basically selecting the games, you're now choosing who's going to be at the top of that leaderboard, first ranked at the end of the season. But remember, that wasn't our objective, right? So our objective was to try and make sure that the ranking at the end of the full season, had it been played, would be as similar to the ranking at the end of our shortened season, which we pick. And it turns out, and we didn't really think that hard about this a priori, but it turns out that what the model actually does is it first identifies, okay, there are some teams that had a slightly stronger schedule in the pre-COVID or pre-suspension, and some teams that had a easier schedule, and there are some teams that played a few more games and a few fewer games, just by the virtue of the fact that that date when the league was suspended is kind of random, right? And so we need to kind of even things out in terms of that disproportionate aspect of the fact that that suspension occurred at a random point in time. And then once we even things out, so we're basically looking at, okay, based on our prediction of who's going to win each game, we select games to try and push the outcome to make it more fair, right? So yes, we are shaping the outcome a little bit there. But once we correct for that disproportionate outcome, then what we actually do is we select the games that are the most competitive, right? These are the games that we actually have the least confidence in the predictions for those games. And I think it was interesting because we didn't set out to do this, but it came as an outcome of the project that you choose an objective, which is to try and make those rankings as similar as possible. And then the computer basically says this is exactly how you do it, right? And so choosing games that are the hardest to predict are the games that are probably going to be ones that people really want to watch, right? And that is in no way, trying to skew the outcome. And it's also a great example of an analytics project where you basically spend a lot of time and effort making predictions only to try and figure out what is hard to predict, right? Because most analytics projects are of the form, you make predictions and then you leverage those predictions to make decisions. And here we're saying, no. The games that are the easiest to predict, those are the ones we don't want to play. And so just fun anecdote I wanted to share. But thank you.
I don't recall the NBA hiring you as a consultant, unfortunately. But it strikes me that both your Continental example and your NBA example are instances where firms either did or should have invested in a coping technology that would pay off benefits for the long run. I mean, in Continental's case, that's exactly what happened. Their reaction to 9/11 benefited them when COVID hit. The NBA would benefit. There's undoubtedly labor action coming in the NBA someday, and they could have used a strategy that they developed under COVID to cope with further disruptions. And so these kinds of things can benefit long-run brand or firm value if they only thought of it ahead of time.
Yeah, no, absolutely. I think it's actually the technology that Continental developed with its consulting company that they were working with at the time. That's pretty much industry standard nowadays, but they were leaders at 20 plus years ago in this technology.
Yeah. Patrick, you have fascinating research on how physicians deal with shocks coming not from COVID, but from medical malpractice claims. And I read your paper on this and I was transfixed. Why don't you tell us about that?
Oh, thank you very much. So yes, moving away from COVID for the moment, I do have a variety of different work on this topic of disruption and how it affects people. And so in this case, I was curious, how do physicians respond when they're faced with a malpractice claim? And by respond, I mean, how do they change their everyday work practices? Do they just shrug it off and say, it happens, lots of people face these, it's not a big deal, they move on with business as usual? Do they, take it to heart? Do they learn from it? Do they change their behavior? Because there is a lot of evidence that they've experienced this a pretty traumatic and disruptive event, right? You're basically, you perform some sort of procedure, you see a patient, and then months later, usually they're notified that this person is interested in pursuing litigation. So we're looking at the initial claim, so not the actual lawsuit, but they're basically being informed, hey, I'm interested in pursuing litigation and will potentially do so at a later date, and I'm holding you responsible for this adverse event that happened because of this procedure that you perform. So it's oftentimes, it can be a pretty traumatic event. But again, that doesn't mean that this affects people's day-to-day work practices. And so this was the question we had. And we looked into this. We said, well, someone finds out on, certain day that this is happening, that they have this claim against them, this accusation. How do they behave, and how is it different, from how they behaved in the past? And we found two primary responses that people made. Well, first we found that many people changed dramatically. We were surprised. It's very hard to get people to change, just in any respect, let alone work practices. But we found that people changed fairly dramatically in two ways. So the first is probably pretty predictable. They became more cautious. So what we found was they started ordering more diagnostic tests when they saw patients. They performed more diagnostic procedures. They really wanted to make sure they knew what was the problem before they did anything else. So they increased their caution. But they did a second thing as well. They seemed to reduce responsibility. So they started seeing fewer patients. They started performing fewer of the more invasive type procedures. And so what you put these things together, and what they seem to be doing is they're trying to avoid future blame. They're trying to kind of protect their reputations and avoid this happening again in the future, because then it starts to look like a pattern. So it's not just about getting better and improving, but it's starting to becoming more defensive in kind of how they're practicing their work, and kind of stepping back a little bit and in that sort of way. And so then we had the question, well, okay, so many people seem to do this, but is this everyone? And of course the answer is no, this is not everyone. There was actually pretty stark heterogeneity in who engaged in these behaviors and who didn't. And I think the patterns were pretty interesting. So we found three results here. So first, physicians with less experience were more likely to change in these ways, whereas ones with a lot more experience or just more experience tended to shrug it off, say, oh, this happens to a lot of people, it's not a big deal, and move on. Whereas it was the newer ones that are still building their reputation and forming their identity as a practicing physician. These were the ones that tended to change their behavior in these two ways. The second one was physicians who went to lower ranked medical schools tended to change their behaviors in these ways as well. So people went to top medical schools. Again, they were able to kind of shrug it off, say, okay, this happened, but I'm confident in who I am, and I'm not too worried about this, and they didn't really change. But the ones who potentially felt a little more insecure in their position or were more concerned about their reputation, they changed their behavior. And then the third finding was that people who worked in specialties, physicians who worked in specialties that had low numbers of malpractice claims, where it was rarer, they changed their behavior, right? Because it makes them stand out from their peers. Whereas if you're in a specialty and everyone's getting malpractice claims all the time, you were less likely to change this behavior. And so you kind of just kept on it as business as usual. And what we found, which I think is kind of a really interesting twist to all this, is some medical malpractice claims are frivolous, right? We probably all heard that about frivolous claims. Some have merit. Sometimes the doctor really messed up, but sometimes something happened that maybe was out of the doctor's control. Maybe it really something bad happened and the people were upset and they wanted someone to blame, but maybe the doctor didn't do anything wrong. We found no difference in changes in behavior between whether these were frivolous or not. So if you were the type of person, so in this group that changed their behavior, didn't matter if it was frivolous or not, you just hated that experience of blame so much that you wanted to avoid it in the future, and you became more defensive, and you actually changed how you practiced medicine to some extent. And the people who didn't change, they didn't change regardless of whether it was merited or not. So we can see kind of positives and negatives of both sides, one could argue, but I found it was interesting that they didn't change either. It wasn't that they're more knowledgeable and they waited and the merited ones were the ones they changed and the unmerited ones were the ones they didn't. They really weren't responsive at all. And so that was the project, and I think there's some interesting, as we think about disruption, especially individual disruption, and whether we adapt or not, and kind of the positives and negatives of that. I think it's kind of, it was an interesting example, at least for me, to kind of explore these dynamics.
I have so many questions. It sounds like the one that doctors underwent a voluntary reduction in income if they're seeing fewer patients and not taking on risky cases, that they're actually sort of self-insuring.
So it's it gets a little more complicated than that. And so we were looking at physicians who work in hospitals. And so one way to reduce the number of patients you're seeing is you don't discharge the patient. So we were actually looking at patient discharges. And so maybe you're seeing a similar number of patients, but you're letting the next physician on their shift have that decide whether to discharge or not. So you're reducing responsibility in that way. So it's not clear they're actually losing income, but if we looked at people, with their own practices, that would be an interesting venue to see if that's the case.
One more question, if I may. I'm the chair, so I get to ask questions. Did their malpractice insurance parameters change, either premiums or scope?
So what's interesting about this setting is they don't have to pay anything. So they have malpractice insurance that almost always covers any full amount of any settlement or any result of any lawsuit. And the premium of their malpractice is it's not at an individual basis. So basically the hospital, they're not paying their own insurance, so the hospital covers the insurance, and the amount doesn't tend to vary with individual occurrences. It tends to be by specialty, so some specialties are more liable, to get malpractice claims than others, and that's how the insurance companies are determining this. So these individuals are responding. It's not financial risk that they're responding to, which I find particularly fascinating about it.
Violina, your articles talk a lot about Knightian uncertainty, which is basically Rumsfeld's unknowns. We're seeing in the modern world, we're seeing an increasing number and range of these kinds of uncertainty. What can leaders do from a strategic point of view to deal with these things, maybe before they happen, or at least in anticipation of something happening?
Well, thank you for that question. I'm going to circle back to COVID. Why are we still talking about COVID, right? That was quite some time ago. And one of the reasons for that is that COVID gave us the experience, but the question for us is, have we internalized the lesson from the kind of uncertainty, which is Knightian uncertainty, that COVID imposed on us, and what defines what's called Knightian uncertainty? And okay, that sounds like academic jargon. It's named after Frank Knight, who in 1921 wrote a book, Risk, Uncertainty, and Profit. And his main argument in the book, which was forgotten for a long time, and in fact sidelined by the economics profession because of the message, they really punish the messenger, is that uncertainty is the only environment in which you can make real profits, right? In any other environments, you're in situation of risk, you can insure them, you can sort of build the predicted models, but uncertainty doesn't really afford you that luxury. And for that reason, Frank Knight argued, uncertainty is the domain where those who can exercise informed, right, kind of prepared judgment, but really make subjective judgment calls, are the ones that are able to profit in this environment. You can see why sort of the economists really don't like that line of reasoning. So fast forward 100 years later, and sort of being surrounded by a lot of uncertainty and a lot of uncertainties, right? Sort of that vary in flavor. We heard about sort of technological uncertainty and social uncertainty. We are thinking very seriously about Frank Knight's message. How can we sort of train strategists and leaders to be able to lead under conditions of uncertainty? And I would say that the answer kind of that Frank Knight gave us, and we are working diligently on it, is that he argued that to deal with uncertainty, you really do have to generate new knowledge, fresh insight about a situation that, like we just said, the future does not have to look at the past, like the past. And he wrote about that. So what does that mean for, us and for those who think about leadership and strategy under this environment? The first question, I think, is very personal. So the discipline to ask yourself, is my knowledge and even more my expertise an asset or an anchor? And kind of look at this deeply personally and honestly. The second question is kind of more organizational. The strategic imperative is to build new capabilities to generate knowledge about this new environment, which probably means to talk to experts outside the real estate industry, to form some unconventional partnerships, to look at different corners of the world where maybe some of the social dynamics kind of reveal different patterns. So how to think about knowledge as a critical resource, not only operationally, but for the very foundation of how we make choices. So I have a few minutes. I'll give a very quickly an example of a company that I'm studying right now. It's a German startup that currently is the largest provider of predictive maintenance in the global railway industry. And what's fascinating about them is that they started in a very different place. The company was created to commercialize a patented technology for which there is like a clear recipe how you commercialize proprietary technologies. And they went on this path and they did it very diligently. They had a super disciplined method for exploring opportunities in markets. In the period of 2 years, they vetted over 100 different markets in order to identify the best opportunities. So they were really into commercializing this technology successfully. They have kind of gone on record saying that they're going to build the best sensor company in the world, right? They were ambitious. And then this serendipitous event kind of put them in touch with essentially Germany's largest provider of railway services, Deutsche Bahn. And Deutsche Bahn asked them to apply their technology to solve a problem with a sort of maintenance. And it turned out that their technology, which had tons of applications, I'm talking across 100 different markets, they were exploring where to enter because the technology was that flexible, did not work in that particular case. And so instead of continuing with the commercialization path, that was like well articulated, funded by top VC investors, they decided, they imagined that if they solve this problem, they will be able to collect data and create predictive maintenance and solve the problem of train delays, which is the most sustainable mode of transportation and definitely kind of a core transportation mode in much of Europe. So what did they do? Once they decided to do this, they completely changed their approach to knowledge generation. They moved from sort of developing applications from a clearly developed technology with specific functionalities to working with the railway company in the trenches with their workers, walking the tracks to actually understand what are the problems, how can be solved. And 5 years later, they had developed suite of services with the IoT component, AI algorithms to essentially assess the strain on the railway kind of in different level of usage, and to provide predictive maintenance service. So they took those workers that walked the tracks and manually checked the railways out of the tracks into the offices with a suite of predictive maintenance services. The entire process took about 7 years, which is not a short time, but it's also not a long time to sort of transform their knowledge base. And I'm studying them not because I'm interested in understanding how exactly you can become the leader in the global railway industry, but because I'm kind of looking at the mechanisms that enable them to change their knowledge base and approach to knowledge in such profound ways. So my quick takeaway here is that navigating continuous uncertainty of the kind that we're facing now with multiple interacting uncertainties like in real estate, climate change, demographic restructuring, AI strategically requires capabilities to develop new knowledge as a part of the core set of activities that any organization that is seeking to lead and not just adapt kind of needs to do.
Well, thank you. We're out of time. I hope we took two things away from this discussion. Number one, there are ways of dealing with uncertainty, risk, all the things that are facing modern society. And the second thing I hope you take away from this is that the UCI Paul Merage School faculty is brilliant at dealing with all of this stuff. So thank you very much for listening.
And thanks again, Ed, for putting together such a great group of panelists from UCI. Next up, we have a real estate panel that's sponsored by our own Tim Kavahara here from the UCLA Anderson Simon Center. So take it away, Tim.
It's on here. Okay, thanks, Clement, for that. It's a pleasure to be here again. My name is Tim Kavahara, Executive Director of the Ziman Center for Real Estate at UCLA, which is a multidisciplinary research center based at the business school. Happy to have a couple of folks with me to sort of opine on maybe some of the things that were said earlier, and then give some insight into where things are kind of on a macro level, but then drill down, obviously, into Orange County as well. So with us, we have Tom McCarthy, who is on the Ziman Center board, an alum of Anderson School of Management. I think he also served on the board of advisors for the school as well. And he's started a company called McCarthy Cook, so he's co-president, co-chief investment officer, I believe. So we're very happy to have Tom here. He has a lot of interesting information to impart. And then he insisted we were going to sort of do a fireside chat, but then Tom said, "Oh no, you got to bring in my guy, Mike Coppin, who is senior vice president of leasing, and I think you focus primarily here or largely here in Orange County." So you have a lot of interesting information and statistics about this market as well. So I don't know if you went to UCLA, but as long as you didn't go to USC, I think you did. There you go.
Class of 2000.
He did. He was a water polo player, a goalie. You could see you're not getting the ball by this guy, either in the water or in real estate or in business. And he's quite an athlete, and you had a lot of fun with Mike. But this is an all Bruin.
There you go. Yeah, Bruin too. Yay. And since you're used to being in the pool and you're used to being on the beach in Manhattan, I guess socks were optional for this group too.
Yeah, either that or I packed the gym bag when it was dark and I forgot to put the socks in. So that's the way it goes. I'm not trying to be a cool kid by any means. He's the cool kid.
Yeah. So why don't we just start out real quickly and start like kind of really macro. And there was a lot of conversation about the war that's going on and all the geopolitics and everything that's going on and how it's throwing the economy upside down. But I mean, do you guys think about that as a company, or is it just you don't think it's going to actually influence at your level, or how do you think that in terms of a macro level?
Listen, all of us who are in the investment world think about risks, right? And that's what we're in business to do, whether it's real estate or equities, public equities, private equities, venture capital, doesn't matter. We're all paid to assess risk. And along those lines, I was telling Tim I'm going to write a country song someday, and it's going to be entitled, "What Risks Am I Taking and What Rules Am I Breaking?" And that kind of summarizes the way I look at real estate investing. We all know that there's certain inviolable rules until you violate them. And for example, location. Well, you know what? We break that rule every day when we make an investment because none of us can afford to buy the very best well-located property in any asset class that we're working in. So that means our thing is always a little off main and main, and how do we accommodate for that? That's one obvious risk. There's a million others. But we're always trying to assess how much risk am I taking given the opportunity that is presented, and can I mitigate those rules that I'm breaking? And if I keep that in mind and somehow we're disciplined about what we do and we don't lie to ourselves too much, it usually works out.
Yeah, and there's obviously a lot of uncertainty in the market right now. The one thing that the real estate industry and most industries like is predictability, and we don't really have that right now. So also when you think about inflation and monetary policy and tariffs that are on and off, I mean, how do you think about that in terms of managing the risk that you just talked about?
Well, real estate's like I analogize it to the coral reef. The fish may come and go, but the reef is going to be there, and we can't move the reef. And so we've invested in office buildings, say in Costa Mesa. We have an 800,000-foot project here, a 600,000-foot project in West LA, million-foot project in San Francisco. Nothing we can do, guys. I mean, we can make those buildings more competitive. We can do what we can to try to win the local game. But if the game's not on, or something has happened that, the game has changed dramatically. There's not much we can do. We got to do the best we can with what we've got. We can, however, change as we look down the fairway, as we think about new investments, how do those risks impact us? And I think right now, given the global risk, and this is reflected, I think, in the few number of transactions that have taken place in Southern California as it relates to office, but I think we can also apply that to other asset classes. It's very slow out there, right? There's not a lot of deals trading, and equity investors. So now I'm talking about institutional equity investors, from pension funds and endowments to public companies, to private equity. They're all very skittish, especially about California right now. They're super skittish about Los Angeles. They are a little bit less skittish about Orange County and San Diego, but still, not ready to go.
Yeah, so would you say that institutional players are taking more of a defensive stance now in underwriting, and because there's a little more scrutiny?
So it depends on the institution.
Yeah.
If you look at the big core funds that are out there, they've had a really difficult time. Their queues for redemptions have been large, although they're diminishing, but many of them are still struggling to work through their problem projects. And then there's the opportunistic capital that's out there, some of which has been raised. Not a lot has been raised in the last couple of years, but there's probably $500–600 billion of capital looking to go to work in real estate generally in the United States. And some of those firms are kind of looking at office and going, maybe if we can get the right project at the right price, two big questions. And they're definitely looking at San Francisco.
Yeah, I would say it's probably also location. I mean, believe it or not, San Francisco downtown financial district was sort of like the poster child for the doom loop. And now we're seeing green shoots, and actually everybody's trying to buy in San Francisco, which is sort of shocking compared to what you heard in the news 2 weeks ago. You guys have a building up there, but again, mitigating risk. You actually sold that building, but you still maintain it in terms of servicing it and fees, and
Right.
so you...
Well, it depends which hat I'm wearing. When I was wearing my own personal balance sheet hat, it was like during COVID when cap rates went down to like 3 on San Francisco office and interest rates were 0. And we got a valuation, and we had an opportunity to put our interest to our partner, which is JP Morgan, and they wanted it. And we said, wait a minute, we better sell this thing because it may be the last chance in my career to put some money in the mattress. So we did. But we retained leasing and management and construction management, and we own another big building, a biotech building nearby, and we've got assets in Mountain View and what have you. So we didn't exactly bail out of the Bay Area, but we did reduce our personal exposure. JP Morgan, for their part, increased their exposure by buying our interest. It wasn't that much, but they did buy it, and now we're helping them recover because the value of the building went from $1 billion to $600 million, and vacancy went from 2% to 40% in that particular 1 million foot asset called China Basin next to the ballpark in San Francisco. And in November, we signed a lease with a company called Sierra AI, because I know we're going to head into this department next. Sierra AI, I don't know if anybody in this room has ever heard of them. There's probably a few of you who are more attuned to current technology and AI development than I am, but I had not heard of them. They signed a 300,000 square foot, $100 million lease. There's a company, a couple of guys out of Google and Salesforce founded, and raised some VC capital and got a valuation of, $1 billion, and they raised like $400 or $500 million, and signed a big letter of credit to support that 7-year lease obligation on 300,000 feet at $80 net. I mean, that's a big commitment, and yes, I was around for the dot-com blow-up, and I saw these, I kind of feel like, oh my God, here we go again, but they are leasing, these companies are leasing space way ahead of hiring people. Way ahead of hiring people. There's an article in the Journal this morning if you saw it. But it's definitely happening again. And last week we put an offer in on a building called 55 2nd Street, which is KPMG's headquarters. They're about to move out in San Francisco, and the whole game plan is to take a 375,000 foot, currently 90% leased building that's going to 20% leased, and the market is bidding on that vacancy. Buying vacancy. So we haven't seen that since way before COVID. So that's like, wow, I never thought I'd see that again in my career. You couldn't do that in Los Angeles or Orange County or San Diego. Nobody would do that. What you want here is if you buy anything, it's fully leased, long-term, right, walled, weighted average long-term on the leases. That's what you're looking for, stability. You want cash flow. San Francisco, we're buying vacancy. So it's crazy time again, which means people might make a lot of money. You're buying that building for $375 a foot. It'd cost you $1,200 to $2,000 a foot to rebuild it. So I don't know, maybe.
Yeah.
But we put an offer in.
Yeah, so since you brought up AI, why don't we talk about that just a little bit? I mean, in terms of what AI being a demand driver for space, but then also how you might be utilizing the technology and managing your own company. And Mike, you could jump in too.
Yeah, so AI, we're all dealing with it and trying to figure it out.
Mentioned about 6,000 times this morning.
Yeah, no, I know. It's right. So, yeah, if you're in the right place at the right time, AI is a beautiful thing because you have tenants that want to lease your space. That's great, right? Meanwhile, we're seeing big layoffs, and the big concern. I attended a conference yesterday that was put on by a company called K1, which is a private equity firm that invests only in SaaS companies. And they've been doing it for about 20 years, and they've got about, $5 billion under management in 5 different funds. And this is their annual investor conference. And I mention this because, of course, every person in that audience is like, I invested in your fund, and it's a SaaS company. Is it, what do they call it? SaaS, whatever, SaaS apocalypse or something. It's going down the drain, right? Who needs a SaaS company? Because every guy with, LLM can just hack whatever software, reproduce whatever it is. And so there were 6 or 7 companies that presented, and then we had a chance to talk to the CEO and the management team. And what they're seeing is interesting. They're companies, and imagine I'm going to use a company that's not part of their portfolio. The Paychex as an example. I'm an employer. I mean, we're a small employer, but imagine we're kind of a medium-sized to large employer. Do you really want to take personnel stuff on your own? Do you really want that stuff? I don't want to do that. No. So am I going to pay somebody to create a new paycheck, a new version of Paychex so I can administer my own payroll? No, that's a waste of time and money. I'd rather pay Paychex, and they've got the risk, they've already got the technology and all that stuff. And that's what I was hearing from these software companies. Hey, we're embracing AI to make our products more effective, more efficient for the consumer who is going to continue to pay us their monthly fee, because it's a subscription model that most of these software companies have. And I don't know. I'm paying attention to that. I think there's logic to that. So maybe I'm not freaking out as much as I was 24 hours ago. And I was freaking out. I was like everybody's going to lay everybody off because Google's laying off thousands of people. But I'm not sure all these SaaS companies are going away. And in fact, I kind of think there's logic to this. Why build something that isn't really part of your business? You should be spending your time bringing a new business, marketing to your customer base, not worrying about the $300 subscription for your stupid, SaaS product that really functions well for you. Why am I going to, worry about hacking that? So I'm guardedly optimistic.
Yeah, and I think on a macro basis too, you can look at what we predict to be the aggregate of, impact of AI and how it affects labor and personal growth, right? So obviously, if people believe that AI is going to, increase your personal productivity by X amount, therefore you're going to need to hire less people by some percentage point, then clearly over some period of time you'll have less labor demand and therefore less office demand. But I think that's over a longer period of time, and we'll see how that plays out. But I think there are going to be, and have certainly become, green shoots of areas where AI has created some net gain in certain submarkets. Number one, obviously data centers, right? The demand for data centers, demand for high-powered infrastructure, warehousing, and then for office, even some of these AI companies that are now venture-backed. These venture-backed companies are forcing them to work in the office 5 days a week. They're not putting their billions of dollars into these firms without having them be at the office and working productively. So we are seeing a net gain in some avenues in terms of demand for the right product type. And that really goes hand in hand with Orange County, at least in Southern California for the most part, is this bifurcated recovery of asset types, premier, trophy, hospitality-driven assets versus the commodity class. You've got 2 different supply sides and 2 different demand sides, and it's a tale of 2 cities. And so it's really hard to kind of, when you start to dilute the data between those two and look at it collectively, it's not always the clear picture.
I think what's been common in the recovery so far, depending on where you are and locationally, has been flight to quality. So I'm sure you've probably seen the same thing here.
Yeah.
Class A is what's filling up, and
yeah, and it's really flight to experience, right? I mean, the quality was kind of something they've had that phenomenon for some time, but the experience is really what people are going for now, because we're not competing necessarily with the guy down the street. You know, Irvine Company's got a beautiful building in Spectrum. We've got a beautiful building here. How do we compete amenity to amenity, the amenity war that people talk about? We're competing with people's homes. We're competing with their work-life balance. We're competing with the flexibility and comforts of their home environment that they have. You know, I was actually alarmed. You know, in the U.S., 80% of the office workers are still either hybrid or remote, and that's been a consistent, stabilized data point for past 6 years.
I've heard the term residential, where you actually are creating a lot of the amenities you have at home, and you have to do that at work now to get people to come back. So whether that's espresso bars or pickle bar station, pickleball, and all that sort of stuff. And, but as you say, it's experiential, and that's what you guys are building, right?
That's right.
Yeah, we have to. That CRAI deal, Sierra would not have moved to the project in San Francisco if we hadn't committed to build a $30 million amenity series of amenities, including restaurant, gym, you know, break rooms, conference center like this. $30 million. Once they knew we had committed to do that, and we did it contractually, they said, okay, we'll sign the lease, but we're not coming if you don't do it.
And it's, you know, it's really the physical attributes of redeveloping a campus, you know, is obviously the beginning, and that's always been the case, where you have to reimagine and redevelop and raise the level of your asset in order to meet the demands of the marketplace. But really, it's as much about the operating system as it is about the physical real estate, right? And that's that hospitality concierge model. Because that truly is probably the differentiator that brings the tenants and ultimately retains the tenants. You know, there was a quote that just said, you know, hospitality-driven owners, you know, they view tenant experience as a measurable asset management function, right? And if I can measure their happiness, their performance, and the efficiency of the campus, you could probably predict retention. And I think those are all measurables that we're now digging into as
more like a hotel service provider.
Absolutely, yeah. We're not passive rent collectors, not that we ever were, but that's really the feudal model of the landlord-tenant, and now we are, you know, campus operators.
Yeah, and it was mentioned earlier by the economist Mark, who did the Orange County, that he viewed AI as potentially being a threat to office occupancy. Particularly because some of those jobs that may be replaced are going to be office-type jobs. I mean, is that something you guys are factoring in terms of mitigating risk, or?
Not at the moment, because it hasn't played out. And as I said, there's been enough AI-driven companies. You know, you remember in the dot-com days where if you had a .com behind your name, you were getting venture capital money like nothing. You know, this was back in the beginning of my career in 2000. And now, if it's .ai, same thing. People are just throwing money at these companies, and these guys are leasing office space. So again, it's nuanced, right? Depending on the market, the asset, the location, and where those companies will go. I mean, we've been talking to a handful.
Yeah, there was a dot-com bubble, obviously. Now people are beginning to ask the question if there's going to be an AI bubble either. And I don't think any of us know the answer to that yet. But
a little early, right? We're hardly into the first inning.
Yeah, but since we're on office already, and let's switch in particular to Orange County, where you do most of your work. But you know, the charts we saw earlier indicated a kind of a slight uptick or an improvement in the office market in Orange County. What are you seeing? Even like what's Irvine versus Costa Mesa versus wherever?
Yeah, it's. You know, it's really a multifaceted kind of response, I would say, and it's not you can't peg any one particular industry or, you know, demand trend that's creating some of the growth. It's a tale of multiple facets. One is it's a supply side recovery. You know, it's a bifurcated recovery. Number one, while tenants are, you know, continue to right size after they roll their lease, and they're right sizing going from 20 to 15. Or whatever their efficiency model is, they're densifying their space to some level. They're creating really habitable environments for the hybrid workforce, which is a different way of using their office space. You know, office space typically was designed for peak occupancy, peak utilization. You know, 5 days a week. How can I, you know, model this programming and then build some growth into it? Now they're looking at office as a completely different model, where I need to create this activated environment that's going to bring tenants my employees to the workplace as a collaboration hub, as a cultural reinforcement tool, as a place to bring someone to get them from home to the office, so that it has to be a better experience than what they are having at home. And so I think you're seeing a lot of that take place within some of these prime assets. And so those prime assets maybe represent 10% of the entire market, but those 10% of the entire market, Irvine Company owns quite a bit of them. We own, luckily, one or two ourselves. And you're seeing a completely bifurcated, upside. You're seeing rents being pushed, you're seeing vacancy decreasing, and so it's really a push and pull. But I think the biggest catalyst of that is the supply side, is where we are taking off upwards of 8 to 10 million square feet of a 100 million square foot market. And so between just the inventory denominator,
What do you mean by we're taking it off?
meaning the conversion, so the projects, there's probably 8 to 10 million feet, depending on what report you read, of obsolete office projects that cannot cover their debt service ratios. And ultimately are just antiquated projects in general. They're becoming residential or medical buildings or other adaptive reuses.
Give an example of one.
There are a cluster of probably a dozen buildings in the airport area off of Dove and MacArthur, quite a few of them over there that are becoming both townhomes and other multifamily apartment assets. And so, not only do you have the inventory that's being pulled off the market from those conversions, but then you have, let's say it's 50% leased, one of those buildings, then you have dislocated tenants that need to go somewhere. So that's creating kind of a 1.5x swing, right? You might take a 1 million square foot building off the market, but you have 500,000 feet of tenants that have no home. And now they need to go and fill in a building that is remaining, which in most cases are higher prime trophy class buildings. And so it is creating a little bit of demand by pulling off this inventory. So I think it's just a recalibration of getting rid of some of the old obsolete product type that just wasn't leasing to begin with. And it's more bifurcated than people want to admit. I just don't think you can look at the marketplace as we fundamentally did pre-COVID, where it's just Class A, Class B, Class C, and let's measure the fundamentals. I think you have to look at it from these different asset class nuances and segment it accordingly, so that I can judge my peer set, how I'm doing within my peer set, as opposed to how I'm doing compared to that Class B or C project down the way. That's obsolete. It doesn't make any difference now. You compete with your class.
How's remote working factoring into? Do you think we've hit kind of equilibrium, or are companies still trying to figure that out?
That's been a stable 20 to 25% of the workforce is still remote, when 50 to 55% is still hybrid. And
you talk about this concept of a utilization gap.
Yeah. Yep.
So maximizing efficiency of space. So maybe you can talk about that a little bit.
Yeah, that's an interesting thing. We dug into it. Our project here in Costa Mesa, we're doing quite a bit of amenities in our hospitality efforts. 3 new restaurants, a beer garden, and a pickleball club. And the pickleball club is utilizing what would be considered underutilized and or obsolete parking stalls. So if you've got a campus, in our case, 2,500 stalls, and even if you're 80% leased, your utilization is on average between 40 and 45%. So if you look at the week, Monday through Friday, it's kind of a bell curve, right? Wednesday is kind of the peak day. And so on average, you've got this 40% utilization. Well, you could be 90% leased, 40% utilization. That 50% gap in the middle is that underutilized commodity, in which cases common areas are 50% used, parking is 50% used, restaurants are 50% used. And so you could have this beautiful campus with the best amenities, but if it doesn't have activity and activation and people, you're not going to have a long-term success story. And so people, I always say, are the best amenity. So any way to attract people, create the placemaking, create that destination, it has to be something that people are willing to commute to work.
Yeah. And then other asset categories, did you want to say something, Tom? Other asset categories, I know you guys do a little bit of industrial and maybe some life sciences too, but is life sciences going to be, there's going to be a market for that in Orange County? I mean, we obviously San Diego, parts of LA, South San Francisco, Boston, but do you see a budding life sciences industry here?
Life science is a great story. It's an example of the commercial real estate industry destroying a perfectly good asset class, together with a lot of exogenous factors, such as cutting funding for research dramatically. But a lot of smart office developers decided, like we did, although we've been in a long time before everybody else got in it, that they could be a lab developer and compete with Alexandria and some of the other big guys. much now to the detriment of everybody who got in the game, including Alexandria and all the other big guys who have really suffered. Life science will come back. Orange County has a tremendous opportunity, which it's never really capitalized on because we have tremendous research institution like UCLA here. It's close to USC and UCLA. It can definitely leverage it. We've been great with certain companies and with devices, but we've not been a basic research hub the way San Diego has been around UCSD or San Francisco with UCSF, Stanford, and Cal. And so we can, I think, with leadership, and this really gets to the point of everything I want to say today and the message really, with leadership we can do a lot better throughout California. We all know that. I was recently in Florida. I'm sure some of you have been down there or elsewhere in the United States where you've got hundreds of cranes in the air and we have none. We literally have none. Drive up and down that freeway, the only crane is working on the freeway. I mean, it's embarrassing, you know, as one of the largest economies on the face of the planet, and we can't build anything. What the hell are we doing? I mean, what are our leaders thinking about? Who's thinking about creating jobs? I mean, all these politicians, they should have one job. That is to think about jobs. How do we employ more people in Southern California and make it more competitive? What are we doing? We just don't have the leaders out there. And that's the most frustrating thing in our business because we should be in the most beautiful weather on the planet, tremendous place, tremendous people, tremendous institutions, UCI. We should be kicking ass, and we're not. And that's what really frustrates me. And it's, of course, in real estate, super hard to make any money when you don't have any tailwinds, because we're a supplier of product to companies and individuals that want to live or use our space or use it for distribution or retail experiences or whatever. And you need jobs and you need growth, right? And we can't have a zero growth or slightly negative or slightly positive economy and be successful as a real estate industry overall. So that's my speech on leadership, and I'm really frustrated about it.
Yeah, we could have a whole session about just that, right? But there's a cautionary tale too, which is you don't want to overbuild. I mean, one of the things I think that's helping office markets recover more quickly is there hasn't been a lot of new office construction in the last.
I'll take the risk on overbuilding, honestly, all day versus no cranes in the air.
Yeah, I think somebody talked about Texas earlier, and obviously they're building like crazy there. But look what happened to Austin, for example. I mean, they really overbuilt it because it's so easy to build anything there, and now they're in a pretty deep recession in terms of real estate and rents and office markets.
It'll come back.
It'll come back? You think it's going to absorb? It's just a matter of time. And these markets, they'll figure themselves out, right? They come to some equilibrium. I mean, that's what's happening downtown LA has a ways to go, I think, but.
Yeah, we don't know which direction it is. San Francisco is a good example where they've changed leadership in the city. new mayor,
Yeah.
The city, the county supervisors have turned over the board of supervisors. I mean, it's amazing what they've done in a short period of time, together with, billions of dollars of AI investment, and it's apparently 9 million square feet of demand. Mm-hmm. But I'll tell you something else that's interesting. We've just been focusing on this in the last couple of months. I think there's probably 15 to 20 that I can count or have counted. I can only name 3 of them. Relatively young and a few relatively young and large new defense companies in between El Segundo and Costa Mesa. Anduril, of course, stands out in this marketplace, but there are others. And then there's that whole infrastructure that has supported the defense industry, the large the Raytheons and Northrops, et cetera, over the years. But these are all the jobbers, the guys who make stuff that go into our defense products. And they're getting a shot in the arm. Now we're seeing AI come into that space. So in El Segundo, there's software companies developing that are going to be solely providing software services and programming for these new defense products. And then you've actually got the product. People who are actually designing and building stuff, drones or whatever. And hypersonic missiles. There's a hypersonic missile company in El Segundo. This is all new stuff. One broker we know says he's got a 200,000-foot demand looking for space in Hawthorne. The ripple effect of a $1.5 trillion proposed defense budget, is what I think the Trump budget has got, that's significant. And Southern California is in a position to take advantage. LA, South, or Long Beach, and Orange County are in a great position to take advantage of that, and I think we have the entrepreneurs to do that. So I'm guardedly optimistic that is a bright light.
I've heard that from everybody. Obviously, wars are good for certain things, and it is good for aerospace and the defense industry. And as you recall, I mean, you guys, Tom at least knows, you might be a little too young, Mike, but I mean, you know, aerospace drove the economy in Southern California. It was it. I mean, El Segundo, all of that, and then the end of the Cold War basically ended that, and there was a crash in the aerospace industry, which really impacted the overall economy in Los Angeles. And now it's coming back. I mean, all of the folks that I'm speaking to cannot buy enough buildings in the South Bay or North Orange County or Long Beach to feed this growing defense industry.
Yeah, and that's kind of one of the green shoots I was speaking to is just you've got this what I would call defense tech, right? Which is a little bit beyond just aerospace. It's kind of a hybrid amongst you know, the legacy aerospace manufacturing hardware kind of meets Silicon Valley software engineers, right? So you kind of have the knowledge-based labor force that's already here in Southern California from tech and you know and other services, and then aerospace, and kind of the convergence of those labor forces in creating this new you know, this new sector, and that's making a real name both through Anduril and others here in Orange County in particular. And so we're seeing that real green shoot. That's a new emerging sector that has not been here, and that you're seeing a lot of spin-offs and startups come from those, you know, both from SpaceX, both from Anduril and others, and they're focusing on certain corridors between Long Beach and Costa Mesa. And you know, it's great to see. We haven't had an emerging sector like that, and I think it's a unique one. It's not legacy aerospace. This is software meets hardware meets manufacturing in lab.
Let me ask you this too. I mean, we mentioned a little bit about the Inland Empire, but obviously Inland Empire's proximity to Orange County and the dynamics between the two counties, and whether it has an influence over housing or certainly industrial. Is there a pull-push? Are people moving to Inland Empire more? I mean, that's obviously a growth market, but how do you look at sort of the dynamics between Inland Empire and Orange County?
Well, I mean, you can, as far as just comparables in terms of industrial product, I mean, the industrial product here in Orange County, you know, clearly is different than the big box distributions you find out in the IE, but, you know, you're seeing a lot of pressure on local industrial buildings here because of things like SB 330 or Measure K, where you can actually re-entitle an industrial building in a commercial sector for housing. So now all of a sudden you get the benefit of land values and the entitlement of a multifamily or you know, resi townhome project versus what you used to own, which was an industrial building that was capped based on the you know, cap rate and the income that you were creating through your industrial product. So I think a lot of these projects are, you know, owners are saying, well, gosh, I'm going to sell this to a developer who's going to build an apartment building. So now they're seeing an uptick in their values because of that conversion, and that's taking more inventory off the market from the industrial side. So I think it's just slowly starting to recalibrate those uses, and my guess is that the industrial side, especially the big box, will continue to grow, especially in Western Inland Empire.
No, I think that's right. I think we can also look at what's happened at the port. We're seeing demand increase at the port again. There's new development about to take place, some pretty big new development in Torrance that I'm aware of. I'm sure there's others that I'm not aware of. So I think that's interesting. We will have a few cranes in the air in that location.
Yeah, and so I'm going to try to end this pretty soon so we can actually open it up to some questions. But how do you got? What's your forecast for Orange County? You guys optimistic? Depends on sector, depends on location, depends on a lot of different things.
Because I'm a landlord advocate, if you will, and have been throughout my career, my DNA is to be optimistic all the time. But the same token, I do study these things, and there's clearly plenty of things to be worried about, both globally and locally. But I think if I'm reading the tea leaves based on anecdotal, you know, discussions I have with brokers every day, what they're seeing, the clients they represent, the projects they represent, and kind of where things lie, at least here in Orange County, again, supply down, right? 10 million feet coming off of a broad inventory. You've got more and more conversions. You've got the Irvine Company raising rents. They're under a new you know, leadership there, and so they're taking a different spin on the competitive nature of their portfolio. And then you've got, again, a lot of those dislocated tenants from those 10 million square foot of conversions out looking for new space. I've got 3 or 4 proposals with groups that are, you know, being kicked out of their buildings, so to speak. So I think between all 3 of those factors, I'm pretty bullish on Orange County. I mean, it's one of the only markets that's sitting there at 14-15% vacancy and declining, and which is interesting because the leasing volume is still pretty stagnant. So the leasing demand is very selective. Deals are taking twice as long, but the decision makers are highly, highly involved in these decisions and just taking longer to make these more critical decisions. And I think from a long-term standpoint, they're committing more to their environments than they were a year ago, let alone 3 years ago.
Has there been like subleasing activity too? Like people
Subleasing's down. Subleasing
Yeah, okay.
availability is down. Whether it's because those subleases have expired or whether it's because they've been absorbed, it's the lowest in years. Yeah.
What do you think?
What do I think? You heard my speech on leadership, and
Like an antidote to that, this is a pretty depressing one, but we're obviously at our center working very hard to address the affordable housing problem. And we did a study at the Ziman Center. It takes on average 5 years to deliver a multi-family, an apartment building, from pulling your permits to certificate of occupancy.
That's California. That's just in California.
That was the city of LA.
City of LA.
Which is, don't even get me into it. Yeah. But I mean, it was indicated earlier, we need 2.5 million new units in housing, and how are we ever going to build at scale? And a lot of it is political leadership. A lot of it is fighting over land use control, state versus local. DWP, the utility companies are really a problem. The permitting process. And one of the things we did a lot of wildfire recovery work through the center. And one of the things we recommended is, why don't you use AI to at least do the approvals on permitting? I mean, it's been proven other places, and rather than have a bureaucrat stamping a rubber stamp behind a window somewhere, like AI is great, but it's kind of it's kind of the middle. So you have to have it's the end user, and then there's somebody that initiates it, but it does all the work in the middle. Yeah. And there's no reason why AI and these other things can't. But we just need more bold political leadership, and I think we do need to reform things like CEQA, and the regulatory environment this year is pretty tough. But say something positive, Tom.
I'm going to say something positive. Look, we've proven in a test kitchen called San Francisco that you can take a broken city and actually move it out down the path towards recovery and path towards expansion, path towards business creation, entrepreneurship, job hiring, I hope. And so it's possible. And we know it's possible. This is an amazing state. We've got some leaders out there who are trying to, I'm not going to make a political comment about who to support, but you guys figure it out. Who's going to help create jobs and actually has done it and figured it out? I think there's a few people who can do that. And we got to get behind it. The real estate industry, and I know not all of you are in the real estate industry, but our industry has been pretty lazy, honestly. And I watched things like in Los Angeles, the mansion tax get passed with no resistance to speak of from the real estate industry writ large, aside from some brokers, residential brokers. That is ridiculous. We were on our hands and just kind of went, oh, okay, whatever, and it decimated real estate investment in Los Angeles City. Nobody, no institution wants to buy a building in LA. They don't know what's coming at them. I mean, that's stupid. So we need to be, proactive. We need to be thoughtful. We need to be aggressive in a polite way. I mean, we're trying to be logical. We need to create jobs. That's really where it comes down. So I think we can do it. And I'm in for the fight. Let's try. I mean, that's part of the fun of this thing, is being involved and see if we make a difference. So that's the optimistic side of the story.
That's awesome. So why don't we get like 5 or 6 minutes left? Any questions from the audience? Why don't we go right up front here?
We got a mic for you here.
There you go.
Oh, thank you. I have a question. You've all been through the .com, and now we have AI. And I know AI is a lot better funded, but a lot more massive. Is there a concern about the parallels of because we're going so quick, so fast with AI, that we could be going down the same path eventually as the .com?
Yeah, absolutely, right? So let's be real. Let's look at it from the stamp, because there's a million ways to look at this and be concerned on a million levels, as AI could do or not do. But just as a real estate investor and a landlord, is Sierra AI a real company? And that's one example, but it's one of our tenants, and we're looking at others that are smaller, less well-funded, and we have vacant space. We need to lease it. We're going to figure out a way to do deals with these companies. Are they going to blow up? Are they ever going to find enough employees to fill all that space? And why do they need them? They're an AI company. Why do you need 5,000 employees if you're an AI company. I guess, I don't know, that seems to rub me the wrong, why? I don't get it. I thought the AI did everything. So, yeah, we're worried about it. We did take warrants in those .com companies. Those all went on the wall of, in the bar. It's kind of a,
yeah, and AI is changing rapidly. We created a course in AI and real estate at the business school at UCLA, and we're putting that professor to work because he literally, it's a new syllabi every year. It's going to be a different syllabi next year because it's changing so rapidly.
education itself is going to change dramatically, right?
For sure. I mean, we have an eds up here right up front. He teaches, but there's a lot of question about how you put your courses together. There's a lot of questions about what the proper use of students in AI, and there's even a question on how to evaluate their work. Like, I mean, it's still new, so they can kind of tell if it's GPT or whatever created, but maybe there needs to be more oral defense from students so that you can really determine if they really understand the knowledge.
I'm more concerned about the power infrastructure that it's going to require. Just these massive. We just don't have it. These substations that have to go up in order to support these.
I think it's a tremendous tool, though. I think it is going to create some efficiencies and some advancement. I mean, listen, the internet was the same way, and yes, there's some really bad things that were created by the internet, and there's some really good things that have been created by the internet. So we'll see. Question in the back.
I've been really puzzled in terms of some of the trends, and I really appreciate your insight. Let me start with the macro stuff. We're going to basically stimulate the economy by $1.5 trillion that Trump's coming through. The war is always to stimulate the economy, and this is a side effect. We also have shifts in demography, and it's really impacting where I live, and I own properties, and I face that. The existing tenants I have are different than they were 10 years ago. There is also a lot of ambiguity. We tend to focus on AI. There's a lot more going on than AI. So if you look at the broad spectrum and the trends which are coming through, for example, the war right now, we focus on the canal, on Hormuz, but it's much larger. There's competition with China. There's alliances developing between BRICS. All of those things, sooner or later, are going to have effect on us. So if you take on that broader spectrum, tell us where the opportunities are in Orange County or in the US. Where would you go invest, buy real estate, and what type of real estate? Income properties, industrial, commercial. So that's what I'd like to broaden this conversation that we have this afternoon.
Well, I don't have that answer, and I'd love everybody in this room who wants to grab the mic to give us their opinion, because these are risks and macro evolutions and situations that we can't predict and can't control. And we are reactive in the marketplace to perceived demand, either currently or in the future. And what makes investing so difficult is our inability to look around the corner and to know how is the blockade of the Straits of Hormuz going to influence industrial demand in the IE. I have no idea. And how is that going to impact rental demand for office space in Costa Mesa? Well, it's going to help probably because there's probably a few defense companies. It might help. There might be part of that 1.5 trillion, spent locally, and that might help our local demand. But then again, if the overall economy goes into recession, which it looks like it could, because of price of oil going over $110 a barrel or wherever.
Today.
Yeah, I mean that's an exogenous factor that you got to live with it, and you're either in the game or you're not in the game, and you might choose to stay on the sideline, and that's when I'm saying that I don't think there's any real equity capital out there to buy office buildings today because nobody knows, even at a good price, $100 a foot, $100 a foot, first class AAA building in downtown LA won't trade. The thing is a $1,200 a foot minimum to replace.
Going back to the bank.
Yeah, nobody wants it. And that's, the perception of risk. Risk has got a very high premium on it right now, or it should. So I don't know. I didn't answer your question because I can't
and the
answer.
Strait of Hormuz is the issue, the geopolitical issue today. It's going to be something different tomorrow, and I think the industry has to be able to adjust to that. In the short term, I speak to construction guys this past week, and they're paying 10 times more for asphalt because it's a petroleum-based project. But then in terms of looking at where opportunities might be in real estate and where to invest on a national basis, there are a lot of folks that I know that are based in California that are not investing in California anymore. If they're multifamily guys that are maybe going where the job growth is, so maybe the Southeast or Raleigh and some of these other areas too. So you just need to be, I think, a lot more nimble and flexible these days. And yeah, one more question. This will probably be it.
Tom, you're running a pretty successful company. What keeps you up at night?
What keeps you up at night?
Well,
dog.
The dog sleeps great. Sleep apnea. Honestly, it's the frustration of the hand-to-hand combat that it takes for Mike to do his job. I've been around long enough. I'm fine, but I worry about Mike and the guys coming up the ladder. Young men and women that we're hiring today are trying to hire or choose not to hire because we don't have enough, demand in the business for these UCI students. I worry. That's what really bothers me. My granddaughter is 14 months old. I worry about them. So that's what keeps me up at night.
And with that, I'd like to thank these two guys for joining us. It's been a pleasure speaking with you this afternoon. And I don't know if Clement's coming back up or thank you.
I'd also like to thank Tim again for moderating this wonderful panel. Thank you, Tim. So that wraps up this conference. Thank you all for attending. I'd also like to thank the UCLA Ziman Center for Real Estate, as well as the Paul Merage School of Business here for co-hosting this event with the UCLA Anderson Forecast. And lastly, I'd also like to thank the sponsors that we have at the Forecast once again, which you see on the right and the left panels throughout this entire conference. So at the principal level, we have RSM and Yamava Resort and Casino at San Juan. We have at the platinum level, law firm of Allen Matkins, Cathay Bank, Federal Home Loan Bank of San Francisco, Mercury Insurance, and University Credit Union. At the gold level, we have Bank of California, Hub International, Leap Development, Robert Half, and SMBC Manu Bank. At the silver level, we have McCarthy Cook and Company. At the bronze level, we have Gensler and MBK Real Estate. And at the Bruin level, we have Cushman & Wakefield and IMA. So with that, I hope you all have a great afternoon. Thank you.